The market was already worried about global growth. It was already worried about UK fundamentals.
Things are pretty unsustainable at the moment, and it's all tied to policy officials raising rates.
I would love for Powell or someone to come out and say, hey, we're just cleaning up the mess made by fiscal policy.
This is not the first time we've seen these kind of movements, and they never seem to be fully priced in. Can we have a bear market rally? Sure, absolutely. 8 to 10% in this kind of environment is not unheard of.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We get it, and we have listened. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. We get it and we have listened. We're not talking about the audience feedback and sitting around a desktop.
No,
we're talking about the Chancellor in the UK.
I got up at 1:17 to watch history made in a fractured Great Britain, John, and all I can say is the excitement of last week folds right into this week. Can I just say around all the present news, it's a huge week of USD.
Couldn't agree more. Bramo, I think we call the UK a U-turn. I think that was a U-turn.
That was a U-turn that is really not a very face-saving measure. I mean, how much does this actually give credibility to an administration that already has caused incredible turmoil in the markets? The question now is, how do they follow that up with some sense of consistency, some sense of stability, some sense of unity among conservative policy members?
I'm so pleased you led with a market reaction. For me, how the market responded last week is so much more interesting than the policy that was announced the week before, Tom. So much more interesting.
Well, some of it is real simple. I'm going to do later. Let's do 10-year gilt right now. And yes, it's improved a little bit for Prime Minister Truss, John, but it's right at, on a yield basis, at support. There's been very little makeup off this U-turn.
I don't want to get into the weeds too much too quickly,
sure,
but the number the Bank of England has spent so far in the gilt market operation, 65 billion is the total of the package. I spoke to David Goodman over in the UK in our London team. 3 to 4 billion sterling is the number so far. They haven't actually had to spend that much, Tom, to calm this market down.
Same with the intervention in Japan going through to 145. But on the Britain LDI pension crisis, every adult I talk to says, beware, there could be more.
And pretty much every note I read over the weekend, Lisa, said the same thing. Fragility, financial market instability.
Everyone seems to feel like there's this whack-a-mole playing right now where there are nodes of instability and policymakers come in and try to, just basically bandage over that for the time being. And then everyone seems to look for the next band-aid, the next problem, the next node of potential contagion.
Question to John. Where's the Labor Party in all this?
I think they let this play out, Tom. That's what you do.
Just bite your lip and
you just
quiet.
Give them some more rope. Give them another shovel to keep on digging. That's what you do when something like this plays out.
And this is Civics 101, but we have a schedule of elections. Do you have a schedule of elections in the United States? For
nothing on the
Prime
calendar right now. We know that it's got to take place by a certain time, Tom, and it could happen before then, but nothing on the calendar right now.
Okay, absolutely fascinating. I'm learning as I go, folks, and what we're going to do is follow the markets here. John, to start the data, what do you got?
I think we've got to start with Credit Suisse. Lisa, front and centre, you're talking about all these little files we've got to put out. Credit Suisse is down by 8% in Swiss trading. We're getting absolutely hammered.
Yeah, and this comes as the CEO says, just wait enough time for us to be able to give you some sort of plan. And the market isn't waiting. So what happens? How do they address this more quickly? And how do they come up with something that's comprehensive, John, at a time when the market's pushing back and they have a lot of issues?
We were talking about whether this market could wait for the Bank of England on November 3rd. You're going to have to wait for the Credit Suisse CEO until October 27th, Tom. October 27th.
First thing I looked at, John, you can do this on the BQ screen in the terminal for those with a terminal. Price to book 0.21. Okay, it's trading, I'm going to guess, at 1/7, 1/8 of JP Morgan. This is at a point where in America this gets solved by regulators, and the mystery to me, and I'm uncertain, is it the Swiss regulators? Is it regulators in London? I just don't know. But we're at a delicate point where it was in the news. Everybody knows is in the news. Credit default swaps, which I'm not a big believer in, blow out. But where are the regulators this morning? Did they do a cash call?
Are they going to raise capital? That's been part of the story. The story has been they might have to raise capital to install the new strategic plan. Whether they can wait until the end of October.
We're looking for $10,000.
I think it's going to be a lot more than 10K if they do need to raise capital. Credit Suisse is down by about 8%. I'll whip through the rest of the market for you. Equity futures look a little something like this on the S&P 500. Futures are just about flat this morning on the S&P. We are positive 5 or 6 points, up 0.1%. Yields are lower by 5 basis points on a 10-year to 377.45. Bramo, euro dollar, 97. 63.
Yeah, right now we are watching what happens in Europe, especially as you get a slew of different finance ministers and leaders meeting in Luxembourg for the European Union to discuss what's going on with inflation, what's going on heading into this winter with energy prices. We're going to catch up a little later in the show with Maria Tadeo and one of the members of that EU group. I've been watching inflation, and we did see year over year, if you take a look at the overall Eurozone, this is just showing Spain, but if you look at the overall Eurozone inflation, it has reached 10%, the highest level in the bloc's history. How do they counter this at a time when they're dealing with a very politically fraught issue, which we'll also talk about later in the show? Wednesday, I am so interested in how this is going to play out. OPEC Plus is going to meet for the first time in person since the pandemic, potentially deciding to cut oil production by the most, going back also to the heart of the pandemic. How will this play politically at a time when you've got President Biden saying, please do more, please produce more, we need to lower these prices in order to reduce inflation? Oh, and by the way, guess who may come? The Russian oil minister. And how much does that sort of play into the alliance there and create friction between OPEC Plus and the United States and Western allies? And also on Friday, this really is the big event, U.S. non-farm payrolls. The high expectation, the high analyst projection is for 389,000 jobs created. The low is about 200,000 jobs. I'm watching the nature of those jobs. Are they part-time? Are they full-time? Are we seeing a greater number of people coming into the market at a time when a lot of people are saying we need to see the unemployment rate go up to about 4.5%, that's the Fed's target, in order to reduce some of the inflationary pressures? John, is a good number, bad number for the markets?
Are we starting that early?
I mean, honestly, how much are we looking for some sort of deceleration in the labor market to say to the Fed, okay, maybe you don't have to go quite as quickly, and maybe you can just hike and then wait?
Lisa, thank you. It's good news, bad news, Tom. Payrolls Friday. I know you're excited for that.
That's
Bad
a
news,
long way.
good news, good
Come
news,
on,
bad news.
you taught me, John, that Monday, ISM Monday matters.
ISM Monday.
Today matters.
I agree with you. The
We got
ISM
all this
does
other
matter.
stuff going on, but you know what, folks? We'll bring you the data and the econo-babble through the morning.
Looking forward to that. Cable right now, sterling against the US dollar, 111.71. Joining us from Birmingham is Bloomberg's Lizzie Burden out of the UK. Morning, Lizzie.
Morning, John. Well, I'm at Conservative Party conference and I'm sat here with Chloe Smith, the Secretary of State for Work and Pensions. Chloe, thank you so much for making time for me. It's a wild morning here in Birmingham. This budget that the Chancellor had announced was described as reverse Robin Hood. At the one end, you were cutting the top rate of income tax. That has now been reversed. But at the other end, the Chancellor said he'd cut the benefits of people who were not trying hard enough to get a job. Are you not going to U-turn on that as well when it's equally politically toxic?
I think the key point about the growth package that the Chancellor set out is that it is all about getting more people into jobs and getting higher wages. And in fact, you can see that around us as a slogan here at the conference. It's painted on the stairs just over there that we want to be able to deliver more jobs and higher wages. Now, the majority of the growth package set out was to be able to do that. For example, including putting money straight back into people's pockets through the adjustment to the lower rate of income tax. And of course, that builds on the cost of living package and the energy price guarantee. Now, my role is then to be able to help people into those jobs that growth package will create. And that, to me, is a real priority.
So to pay for all your tax cuts, to have any credibility in markets, you're going to have to cut spending. The one thing that the Prime Minister promised yesterday was that she was going to raise pensions in line with inflation. We're in a cost of living crisis. Has the Chancellor asked you to look at cutting benefits?
The Prime Minister was right to talk about the triple lock on pensions. That's been a commitment of ours for a while, and that's been a clear public commitment already. Now, naturally, there is then also the decision to be taken about benefit separating. This is one for me to take in my role. I can't tell you here and now what that will be and what the data that goes inside it will be, because I have to wait for that data to come to me. Now, the key principle, though, that I want to take in approaching that decision is how we can best protect the most vulnerable in our society. And for me, this builds on those elements of the cost of living support that we have already been doing and delivering. My department has been making payments to people, and there'll be more coming out very shortly, that are supporting people at that time of real need.
But why is it fair to guarantee pensions, not benefits, in a cost of living crisis? People need to plan now.
And one of the other principles that I really want to look at here is how we protect those who can't perhaps work to raise their own earnings. So, for example, that would usually include pensioners, and it may well include others as well. These are the principles that I'm thinking about very carefully as part of that decision. But let me also say this. As a party, we are about helping more people into work. We shouldn't be writing people off and saying that they can't work. We should instead be looking at what people can do rather than what they cannot do. So that's what the growth package is all about. And that's the golden thread that you see going through the rest of the work of my department, helping people into work and ensuring that there is an incentive to work.
OK, so you mentioned pensions. Last week, the Bank of England had to step in to bail out the pensions industry from a systemic crash that was triggered by your government. Are you having emergency meetings with the pensions regulator and asset managers? And if so, what proposals are being discussed?
Well, colleagues are having the right meetings, of course, with the pensions regulator, with the Treasury, and across my department as well. I can't give you further details than that, but I'm glad that the Bank of England was able to take the action that they did last week. And naturally, we are keeping a very close eye on this situation because we want there to be a thriving pension industry in this country. That is an essential part of supporting people in their retirement.
Chloe Smith, Secretary of State for the Department of Work and Pensions, thank you very much for joining me. John, the question remains then, what happens when the Bank of England's rescue package ends on October the 14th? Unclear if we're going to have the same issues for LDIs.
Hey, Lizzie, thank you. Looking forward to catching up with you through the next couple of days. Lizzie Burden there out of the United Kingdom. A lot of people describing that October 14th line in the sand, Lisa, as somewhat of a cliff edge for this gilt market and perhaps even for this Bank of England and the government too.
Yeah, how much is this going to have to be a response that we see from policymakers, from Liz Truss's administration? We just saw a response from them. How much is it going to have to be that as the trigger breaker at a time when they're dealing with inflation and the Bank of England is kind of caught between a rock and a hard place?
The city had this to say this morning, Tom. Vasilios Giannakis, walking back on a top-rate tax cut will mean 2 billion sterling less out of the total 45 billion cost for the next 2 years.
I thought his note was brilliant over the uproar of this politically, but the market pros are watching a lot of other data, including the recent inflation we've seen, John. It's higher. Is it going to be higher? It's going to print higher in the United Kingdom.
Live from New York City this morning. Good morning. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. British Prime Minister Liz Truss has done a U-turn. She's dropped a plan to cut taxes for the highest earners just 10 days after it was announced. It's an attempt for Truss to fend off from a rebellion from her lawmakers in her own Conservative Party. Chancellor of the Exchequer, Kwasi Kwarteng, says the tax cut had become a distraction. Truss and Kwarteng will be hoping to end days of market turmoil that followed his fiscal package. The price of oil jumped today. There are indications that the OPEC Plus alliance may slash production by more than 1 million barrels a day to revive plunging prices. A cutback of that size would be the biggest since the pandemic. OPEC Plus meets Wednesday in Vienna. Another defeat for Russian forces in Ukraine. Several thousand Russian troops withdrew from the strategic town of Liman over the weekend. They were outnumbered and increasingly encircled by Ukrainian forces. Liman is in the Donbas region, one of 4 annexed by President Vladimir Putin. In Brazil, the presidential election is headed for a runoff. On October 30th, voters will choose between President Jair Bolsonaro and his leftist rival, former President Luiz Inácio Lula da Silva. Lula had the bigger share of votes on Sunday, but fell short of the absolute majority he needed to win. And shares of Credit Suisse fell to a record low today, and the cost of insuring the bank's bonds against default climbed to a new high. In a memo to employees, new CEO Ulrich Korner said Credit Suisse has a strong capital base and liquidity position. He will announce a turnaround on a plan October 27th. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
All of you who are looking for a pivot, be careful what you wish for, because this pivot only happens if you have an economic accident or financial accident. And the journey to an economic and financial accident is a very painful journey.
Mohammed El-Arian, just absolutely fantastic through last week, guiding us through some of this market carnage over the last couple of quarters as well. Live from New York City this morning. Good morning. The price action shaping up as follows on the S&P 500. Relatively unchanged after 3 consecutive quarters of losses on the S&P. The longest quarterly losing streak going back to 2009. Futures right now up 0.1%. Yields lower by 4 or 5 basis points, 378. I make it about 9 straight weeks, 9 consecutive weeks of 10-year yields climbing, TK. 9 weeks, yields up.
And this is the underplayed story this morning. There's lots of other distractions, including what Lizzie Burden just talked about in Birmingham. But you're absolutely right. It's about the technical construction of yields here, there, and everywhere. As an aside, including in Japan, where the 145 yen, John, we're almost back to that intervention point. And again, that's linked into their yield manipulation. A lot of that going on.
We're going to nail this. Birmingham. You've got this.
Birmingham. Which teams are from there?
Birmingham. Aston Villa and Birmingham.
Aston Villa, I did not
Birmingham
know.
City, yeah.
Would you rather
instead of Birmingham,
Which
Alabama?
Beetle is from Birmingham?
That doesn't really help.
Birmingham.
Which Beetle is from Birmingham?
We can do Brummie accents in the next commercial break as well. We'll practice
Is that what
too.
Lizzie has?
That's not what Lizzie
I
has.
can't even understand.
That's
like
closer
one
to
out of
what
3 words.
I might have had if I'd stayed there a little bit longer.
But you've become posh.
My cousins, I wouldn't say I've become posh. My cousins have a bit of a Brummie accent too.
Okay.
There you go.
Are we done?
That was the clinic, the education.
I want to talk to you, John, right now before we get to Lori Calvasina. A decade per year return. SPX way outdoes Russell 2000, John. SPX up 12% per year. Russell 2000 up 9%. The small caps underperform.
Do you think the return assumptions need to shift lower for the next 10 years?
Maybe they're shifting right now. Let's do that right now with Calvasina of RBC Capital Markets. Lori, is it small caps time?
Hi, thanks for having me, Tom. And I think it is. If you look at small cap relative to large cap, just pull up the RTY against the SPX on your Bloomberg. We've been in sort of a trading range all year on the relative trade. And if you look at small caps, we're basically at historic valuations on both an absolute and relative valuation. We've already priced in a big spike in jobless claims. And typically you want to buy small caps when the unemployment rate starts to tick up. So you want to keep that in mind as we look ahead to Friday. But I will just say this. Small caps have really been orphaned for quite some time.
Yes.
They are more domestic, and we are hearing a lot of interest in small caps, even from people who are very bearish on the market overall. So
Right.
we're overweight, and we feel very good about that call.
In the turmoil we're in, including low GDP, will there be transactions and combinations that combine small caps into mid caps?
It's interesting, Tom. I mean, we have been combing the transcripts among the big cap companies for commentary about M&A, and we're not seeing it pick up yet. So I wouldn't say it's necessarily imminent. But I do think that when you're in a sluggish growth environment, and I think that's the price we have to pay for a short, shallow recession, if indeed that's what we end up getting, I do think companies will try to go out and buy growth. And you know, we find that a lot of small cap companies are also much better run than they were in the past, much cleaner balance sheets, much higher quality management teams. So we think the asset base is more attractive than it may have been in past cycles as well.
Lori, is overweighting small caps a fight to lose less or actually to get returns that are bigger than some of the negative returns that we're seeing across the board on broad indexes?
I think it's a great question, Lisa, and I think that depends on your time horizon. In the short term, as stocks search for a bottom, I do think it's unlikely that small caps will start going up while everything else is still going down. So it may simply just be that you lose less on the way down to kind of find that absolute bottom. But at the same time, I will tell you, Lisa, when you talk to people who've done small cap for a very long time, and you go back and look at the history, the pivots back into small cap tend to be pretty sharp. So I do think it's an area where if you really kind of wait around and try to pick the bottom in the market, you're going to miss the turn. And you do tend to make a lot of that outperformance in those early days in the trade.
Right now, we're looking at 35.85 on close on Friday for the S&P 500. Your target for year end is 4,200. What's the trigger? What's the pivot point that gets us up there? Is it just the bear market rally that we heard about from a number of analysts?
I think that's one thing you can look at. I mean, we actually found if you look at the S&P 500 this year in 2022, it's got about a 72% correlation with how stocks were trading back in 2002, which was another period of kind of painful normalization after a big market shock and initial rally. And so if you sort of go through that playbook, there was a fierce 4Q rally, and then you gave most of it back in the first quarter. That seems like a plausible way for things to turn out this time around as well. I think also, Lisa, we're about a month out from the midterm elections. go back to the summer, I started really getting an earful from a lot of investors about how that would be a potentially positive catalyst for markets. So we do think that's something on investors' radar. And if you look at the generic congressional ballot, after several weeks of seeing the polling data kind of shift back in Democrats' favor, we actually saw the Republicans pull ahead of Democrats in the generic congressional ballot data last week. So things are starting to shift a little bit in a more market-friendly way in the latest data there.
Laurie, just wanted to squeeze this in. Nike, FedEx, Apple, Tesla missing this morning. What are you learning from corporations about how quickly this downturn is coming around?
Well, look, I think what we are learning, John, is that we are starting to see some companies rip off the earnings Band-Aid. And if you go back to the summer, that is something investors were telling me they really needed to see happen to get comfortable with buying markets. People said, we want to buy stocks around 15 times PE, the market around a 15, 16 times PE, but we just need a little bit of certainty on that E. We need to see the numbers come down. We'll see if the early reporters turn out to be a harbinger of what's to come in the actual reporting season. But I do think, kind of getting those earnings expectations down is something that we really need to see.
Hey, Laurie, thank you. Awesome as always. Laurie Cavacina there of RBC Capital Markets. Earnings season unofficially kicking off with JP Morgan, as you guys know, October 14th. So, Lisa, a lot happening on October 14th.
I was about to say, is that sort of correlation or causation that the Bank of England is going to possibly end their intervention on the same day that JP Morgan reports earnings? I don't know. You decide for yourself.
You think the stage was set deliberately that way?
No, I'm just playing around. I'm just playing around. But it is going to be really pivotal. I don't know how much JP Morgan's necessarily going to be the harbinger of what's to come, and if Nike and Tesla might be even more of a harbinger at a time when people are looking at the on-the-ground supply chain disruptions of making stuff, not just financial markets and the engineering.
As you would say, the physical world.
Yes,
the
correct.
Physical world. Tom, third quarter deliveries a miss at Tesla. And that statement, I think, could have happened maybe 12 months ago. Maybe before that. We're still talking about the same thing, supply chain disruptions, and here we are at the end of 22.
It's really important to take this supply chain thing and pull it out farther on the x-axis, and it gives you more uncertainty, and particularly in the United Kingdom, where they're hugely constrained by supply and demand dynamics, and it folds into Brexit and all that. John, I'm just saying the x-axis goes out, and this is data October this week.
So we're pushing out the supply chain problems and bringing forward the earnings issues. That's not great for earnings season going into that next month.
What did Mike Wilson say? That light at the end of the tunnel is really a freight train?
Oh, that's deep.
Yeah. Coming
Super
for
deep.
earnings.
Oh, great. Thank you, Lisa.
Yeah, that was a CFA case study.
Hello, October. Hello, Q4. Here's the price action this Monday morning. Good morning to you on the S&P 500. Leaving behind a monthly loss on the S&P, negative 9%. On the S&P 500 in September, ugly. Futures this morning positive, 0.2% on the S&P. On the Nasdaq 100, down a little more than 0.1%. Yields last month, the 2-year, up 79 basis points in a single month. Your bond market looks like this right now: 2s, 10s, and 30s. Your 2-year yields lower by 9 basis points. The 4.1857 on a 10-year. Let's call it 3.77, down 6 basis points. Would you believe it? Last week, sterling, the best week since March 2020. I mean, seriously.
I really take issue with that.
I'm sure you do,
Strong.
but numbers are numbers, okay?
Yeah.
Sterling's here right now from 103.50 a week ago to just short of 112, Tom, at 111.97.
Technically, John, it's massively indeterminate. I got a 111.97 now on yen. I'm buttressed right up against intervention 0.14509. I would say developed nation currencies are working this morning.
I don't think the volatility's over. Let me be clear about that. I really don't. In fact, I think that was the story of what happened in the last week. I don't think it was the policies announced by the UK. They're debatable. We can have that conversation. But the fact that this market was so fragile in response to them, Tom, the fact that the Bank of England had to come in with a gilt market operation, think speaks volumes, and there's big lessons for us all to learn.
It looked like Manchester United this weekend.
Not a great weekend, Dave. That was pretty ugly.
Febrile.
I think that was the gilt market.
We'll talk about that later. Right now, we're going to talk about Michael Ferroli, who wrote an essay, as he always does, Weekly Prospects, widely read, from J.P. Morgan on Friday after that tumultuous week. And he said, guess what? This Friday matters for November 2nd. We need to get from the data this week and the jobs report on Friday out to November 2nd. where a Fed will decide. Bruce Kasman joins us now, chief economist at J.P. Morgan. Bruce, I usually go global, but I got to go domestic today. The Fed will decide. How close are we to a Fed that will decide what to do over the next number of meetings?
Well, I think the basic message the Fed is telling us is that they're committed to creating a softer labor market, to pushing the unemployment rate up, that the picture on inflation has been concerning enough, and that they really want to gain control over credibility here. So unless we get a really big downward surprise here, I think we're not only on track for a 75 basis point move on November 2nd, but further big moves in the next couple of meetings after that.
So what does your rate get out to? I mean, the game here, the parlor game is 3 3/4, 4, even up to 5%. What does that mean for the Bank of England? What does it mean for the Bank of Japan? What does it mean for the Bank of Indonesia?
Well, I think the Fed, as we would see it, goes up to the mid-4s, and stopping at the mid-4s in our forecast does require to see a material slowing in job growth over the next few months, which is in our forecast, but obviously we haven't seen yet. I think the Bank of England story is really going to be dependent on how much the government gains credibility. We think they're on track for getting rates up at least to 4%, probably more as we go through the next few months. And as you're noting, there's a number of other central banks in EM that have wanted to slow down, maybe even stop here. They've been using FX intervention. They've been using their rhetoric. But with the Fed moving, with the volatility we're seeing in markets, it's harder. And we've obviously been backing off of what we thought was some kind of a moderation going on in EM central banks.
Well, Bruce, that really raises the question of what point the dollar becomes the U.S.'s problem, not just the rest of the world's problem. What's the trigger point for the U.S. starting to respond for the U.S.'s sake, not just out of some charity for other nations that are really struggling in the face of the greenback?
So I think the big issue here is, does the Fed get the kind of controlled moderation in labor markets and growth? Does it see inflation come down? I think on the inflation story, the dollar rise is combining with what we think is a fairly significant fading in both commodity and supply chain pressures. We think we're set up for a pretty decent drop off in goods pricing here in the next few months. We've already started to see it on energy. And I think the economy actually shows resilience here. It looks like it's tracking 2 to 3% growth in the current quarter. So I think you have a tension that the Fed will get a benefit here on inflation, I think, in the next few months. But it may not get the job market. It may not get the growth number that gives it the comfort to stop, in which case the concern is not so much that I think the dollar is itself a drag in the near term, but the Fed keeps going in a way that it doesn't pay enough attention to the lags, and therefore the economy slows much more sharply next year. Let's realize the risk here is looking at 6-12 months down the road, not where we are right now.
And this really speaks to the column that Paul Krugman wrote at the end of last week in the New York Times, where he basically said, is the Fed breaking too hard? The risks have moved to possibly yes. Do you agree with that view?
Well, I think before we ask whether the Fed is breaking too hard, we want to ask, is the Fed intending to break things? Because if you listen to Powell, if you listen to some other speakers, they seem to be preparing us for a significant slowing in job growth and perhaps a meaningful rise in the unemployment rate. So I think, yeah, there is a risk that they move too hard because they're, I think, concerned about seeing results and not paying the kind of attention to the lags in the monetary transmission mechanism. But there's also a concern that the Fed has decided that it's much more appropriate to risk a recession here than keeping inflation unusually high.
Bruce, none of this is in the textbooks. It's not in the Krugman textbooks, the Mankiw textbooks, the Kasman textbooks. With the survey data on Friday, I have a 3-month moving average of non-farm payrolls of 286,000. That's job formation. Is J.P. Morgan saying that will break, that will slip down to some appallingly 3-month moving average of, say, 160,000?
Well, we have a forecast for 300,000 job gains on Friday. So clearly that's a pretty strong number, even if it's a moderation. I think to get the Fed to pause, you need job growth to slow to at least 100,000 a month over the next 2 or 3 months. That, I think, is a hard one to get confident in. That is what's based on our forecast, that the Fed by the first quarter sees that and is ready to pause. And I think that's the key issue here, both in terms of getting the Fed to pause and also the concern that if they don't see that and they keep moving, that they go further than they actually need to.
Bruce, we got to expand on that. That's a stunning number. I have a run rate back decades of 150,000, and maybe you come up to 200,000 per month for non-farm payrolls is a healthy, a normal America. You're saying we've got to get down to 100,000, 100,000, then another 100,000 to make this Fed blink?
Well, yeah, I think if you want to have an economy in which the unemployment rate is moving in a controlled way to roughly 4.5% unemployment rate, which is what I think the Fed is telling us, you need job growth to be soft. 100,000 may not even do it, but I'd say 100,000 is probably the kind of number the Fed needs to see to be comfortable to be thinking about pausing.
Bruce, this goes to something that you flicked at earlier. Do you think that it's inappropriate for the Federal Reserve to be targeting the unemployment rate at a time when the jobs market has dramatically changed post-pandemic?
I think it's appropriate for the Fed to be targeting a softening in the labor market. I think it's appropriate for the Fed to be paying attention to what's happening in the inflation process, wages, salience, inflation expectations. But I think it's also appropriate for the Fed to be forward-looking, which is to recognize that there's lags in the process, that they're getting a restrictive policy in place. And the difficult call is, do you stop on the tightening before you've gotten everything you want to see in the data? That's really the tough call that they're going to have to make here at some point. I think somewhere in the range of 4.5% seems perfectly reasonable to be pausing, but they may not have the labor market outcomes at that time that makes them comfortable to do so.
Bruce, this is the question, isn't it? I think you just framed it perfectly. How can you be forward-looking if you're chasing a lagging indicator?
Exactly. And you're also being uncomfortable by the fact that inflation is persistently high, that you're worried about salience in terms of the lagged inflation affecting price and wage setting. So it's really, I think, important to be forward-looking, but it's really hard to be forward-looking here.
Bruce Kassman of JP Morgan. Bruce, wonderful to hear from you, sir. Thank you, as always. How can you be forward-looking when you're chasing a lagging indicator? And if you're being emboldened by the labour market data, are you guaranteeing a ton of damage to be done in the not-too-distant future? And maybe we're seeing some of that play out already.
Do you know how much I flunked leading, contingent, and lagging
How did you get
exams?
on? How did you get on?
I just don't believe in it. I get the science behind it and the PhD wonkery of it, but things change. You know, I mean, something that's lagging becomes coincident. Something that's leading, et cetera.
This cycle's moving quickly. I remember Chris Harvey of Wells Fargo came on the programme with us a number of months ago, and he said the weakness you're expecting is probably not going to come until the first half of 23. Then in the last couple of weeks, Lisa, he turned around and said, you know what, it's happening much faster, much faster than I thought it was. And credit to Chris and the team for actually just coming out and saying it. You're seeing it in some of the corporations. It's happening quicker than I thought.
And Lori Calvasina said they're ripping off the Band-Aid with the earnings results and what they're looking forward to. And is it ripping off the Band-Aid, or is the scene just moving so quickly that they're readjusting and they're going to have to keep readjusting? And that's why I think that the earnings season this year is going to be, this next quarter is going to be probably the most important data point, at least when it comes to risk assets and the road ahead there.
A ton of Fed speak in the last week or so. Most important line, you can read the nuance between all the different speakers, the officials. I know that's a sport. I get it. I participate sometimes, often. Vice Chair Brainerd said this: we're committed to not pulling back prematurely. I think that's all you need to know right now from this Fed.
Okay,
and basically what Paul Krugman wrote, and this is the reason why he spurred so much controversy, the risk that the Fed is moving too slowly to contain inflation has declined, while the risk that high interest rates will cause severe economic damage has gone up. And that's the asymmetry that people are looking at.
This is going to go to when we go to Washington for the IMF meetings, and I believe we're going to quiz Adam Posen on this. Are all we doing is a mental ballet to get out to where we impute a new higher inflation level from 2%, where 3% a la Posen is the new 2%. Is that what this exercise is?
They're saying no, pretty aggressively.
Well, but
pretty much every single official.
What did you say about Brainerd? She said it's premature.
Committed to not pulling back prematurely.
Prematurely.
They want to stick with this. What would happen if they started flirting with 3%? I think it would be harder to get to 3.
Agreed.
It would make it even harder to get to 3.
They're not going to do that. They
because what?
Yeah, fair.
If I'm a market participant and they're flirting with the idea of
getting
it's unheard of the new 2, I'd be like, okay, try getting back to 5.
100%, which is the reason why they're not going to do it.
Exactly. They'd have to announce that in Birmingham.
I think that would be a good.
That was
Birmingham.
That was perfect.
Did I do that? That was nice.
Birmingham.
You should go to the Conservative Party conference with Lizzie Burden next year.
Well, you know, I can. Well, wait a minute.
He's like, I can go right now. I've got my suitcase.
He's going to leave right now.
I'm dressed to go. Come on.
Are you Peaky Blinder?
I'm dressed to go.
Did you bring that in? Did you
I
bring
brought
a prop?
that in. I'm
you
dressed
brought
to go.
a Peaky Blinders prop.
Birmingham.
We don't wear
Am I
them.
doing okay?
We don't wear them. Has that got razor blades in the cap?
Yes, it does too. Gillette. They're over here.
Where did you get that from?
It's a secret. My fashion people got it from me. I really don't know.
Have you been watching Peaky
I'm in
Blinders?
Q. No, I'm in Q with Beckham.
Oh, is that what that
That's
is?
what it is.
Okay. All right. Okay. That was lost on me.
How do you say Liverpool?
I think they're going to cut the...
We're going to do that later. All right. From New York, this is Bloomberg.
Loving the look, Tom Keene. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's a humiliating reversal for British Prime Minister Liz Truss. She has now dropped the plan to cut taxes for the UK's highest earners just 10 days after it was announced. The move was Truss's attempt to fend off a rebellion in her own Conservative Party. Chancellor of the Exchequer, Kwasi Kwarteng, says the tax cut plan had become a distraction. In a tweet, he wrote, "We get it, and we have listened." According to a new forecast, demand for European natural gas will slump next year. The IEA says that high prices will result in European consumption falling by 4% in 2023 after a record 10% decline this year. But supply restraints will keep markets tight even as demand slows. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The 45p rate quickly became a focal point of discussion. There were lots of concerns. I listened to people, I spoke to MPs, spoke to colleagues, spoke to people in the country and saw the reaction and felt the best thing to do was to not proceed with the abolition of the 45p rate, simply because it was just drowning out the other elements of the plan.
British politics is absolutely brutal sometimes. That was Chancellor Kwarteng speaking earlier this morning. Good morning to you. Here's the price action elsewhere on the S&P 500. Building on the losses of September, the fears out there big time that might continue. On the S&P 500, futures just about positive by 0.1%. Yields are lower by 6 basis points, 376.44. Yields much higher over the last couple of months. We had a little look at 4% last week. Want to look at Credit Suisse? We're having a little look at 360. 366. Credit Suisse down in Swiss trading by almost 8%, Tom, as we await this strategic plan from the CEO at the end of this month.
The strategic plan at the end of this month. How do they get to the end of this month? Let's talk about this for 3 seconds here with David Harrow, who we've talked to for years as a major shareholder. Do they do a new cash call? Do they sell out to Deutsche Bank? What is the best guess of what they'll do?
The focus is going to be on divestitures and asset sales and
maybe
all of the
leave
above.
America.
They were talking about bringing the First Boston branding back. Maybe, Tom. How long have we been talking about this investment bank? I think I remember going over to see Brady Dugan in Zurich, Switzerland, maybe 10 years ago.
Yeah, you did that. I never did that.
And having that conversation with him then, and we're still having it now.
I would say it's a 20-year workout. I became familiar with the struggle with their acquisition of Donaldson, Lufkin, and Jenrette, who had a close relationship with, and it's been decades, but here we are on this Friday with the Bloomberg reporting over the weekend, and you wonder where we'll be next Friday at under 4 Swiss francs.
Abramo, the pressure on this bank building and building and building and building.
The longer they wait, the more difficult it is going to be to get out from underneath this. I mean, if they try to raise equity, considering the fact that their equity valuation as of Friday was about $10 billion, if they start to raise $4 billion in some sort of equity sale, which is what some are saying that they might have to do, how much do they have to pay up in a coupon payment of some sort of preferred or something like that? Because talk about dilution. What does that do?
The market cap of this bank is a third of what it was in spring of 21, Tom.
Well, there it is. And we'll continue to follow this with our great team in Zurich and also in London, I should point out as well. In Luxembourg, Sebastian Galli joins us right now, senior macro strategist at Narda Asset Management. Sebastian, I'm going to go to one sentence there. It can be the U.S., it can be every other country. You say inflation will plunge. Why?
Yeah, the way you look at it is we had this big surge in demand, particularly from the U.S., a big surge, a big issue in terms of supply chain. Some of it is because of low investments for a long time, as was COVID-19, and that's created this enormous surge in inflation. And everybody gets excited because it becomes a consensus trade, and people are very fearful of it because it's just spectacularly unhelpful. The question happens when demand slows down and inflation is very high. Well, one of the reasons it's so high is because the markups are insanely high everywhere. People have been gouging prices for any goods like a Coca-Cola good or a can or something of that nature, and it stays too expensive. And as demand cools off, eventually these markups fall very brutally. And another issue is that some of these goods have been overpriced so much that there's actually no demand for it because it's oriented towards weaker households.
Right.
You go to Target and the likes, and they just don't want to buy it, and so they have to cool down.
I mean, Sebastian, to be simple here, if I get the galley plunge, what does it mean for U.S. dollar? Everybody's got a one-way trade to resilient and strong dollar. Is that the trade at Q4 and into next year?
No, because as the Fed basically continues to hike and inflation eventually face much lower than expected, it's pretty freaking awesome for U.S. equities. So you actually want to be long. Of course, the Fed enters into a pause. That doesn't make much of a difference. You're talking about 25, 50 basis points difference. It still gives you that long dollar trade, and it still remains a consensus. It just becomes a U.S. equity-oriented type of trade. So once inflation comes down, not only in the U.S., but also abroad, we're going to see basically a bit of a relief rally in fixed income as well as in equity.
Lisa, that's the massive international economic ambiguity. Many people would say Galley doesn't know what he's talking about.
Well, and other people would say he's dead on. Here we're going toward a situation, Sebastian, where a lot of people are talking about the nodes of contagion. We're talking about the UK as one example and what happened in the gilt market, not necessarily being an outlier. When you're looking at the potential vulnerabilities in this market, what's the next area of concern that you're watching?
Well, if you look at what happens in an environment where people are looking for consensus trades, there are bullish trades, there are very few left. There are bearish trades, and what you end up is people going out with a lot of stories, for example, on Credit Suisse, which are completely unwarranted because the regulators is sitting within the bank. And you are also sitting on people trying to create a phenomenon, a bearish phenomenon, like witches on the top of a hill, and it gets very exciting. The reality is a bit different. The financial stability has become very strong post-2008. It was very weak before, and that is in general in developed market, but also in China, India, and the like. So if you look at a financial stability issue, it might come from sovereign yields, and we see that maybe in emerging markets, but also in developed markets. And we saw that, for example, in the UK with the yield curve rising very substantially, and questions in the European periphery, and then it centers, of course, on Italy and Spain. As the pain economically of high inflation is too high, can they sustain these high level of debts? And the answer is quite mitigated. So it's quite difficult going ahead.
Did Seb just call it witches on top of a hill, and that was very exciting?
I loved that. That was
Were
fantastic.
you writing that down?
Well, I was writing down a couple of things that he had said. I was trying
Seb,
to
thank you, sir.
put that
Sebastian
together.
Galley there of Nordea Asset Management. Witches on a hill.
There are people who are hoping for some sort of catastrophic systemic
Oh.
event, and this idea that there could be some sort of washout catharsis.
Friends of yours.
I'm not rooting for that. Come on. No one wants to see some sort of meltdown. But you do hear this feeling that maybe the, what is it called? The black
things
swan.
are melting down.
The black swan trade, et cetera. That there just isn't the trigger breaker. The Fed can't be it, and policymakers can't be it the way that they have been over the past few decades.
Well, the Bank of England last week had to be it. That was their big call last week in that gilt market operation. Here's the latest in the UK. The Prime Minister has confidence in her Chancellor. There are just things you never want to say. As a bank, you never want to have to call up investors and say our capital position is really strong. And as a spokesperson for the Prime Minister, you never want to have to go out there and say I have confidence in my Chancellor. They're just things you never want to have to say.
Maybe not now, but, maybe end of October we need team coverage again in London.
You'd like to go back?
To cover this? The witches of what?
Circling on the top of the hill.
Is this like
waiting
Macbeth,
to pounce?
Joel Cohen's movie from like a year ago?
This is another more poetic way
It's
of
a great
saying
movie.
nodes of potential contagion.
Nodes of potential contagion.
No, they were so good there at Birmingham.
Who did they open for?
Emerson, Lake and Palmer.
Okay,
they were
nice.
really good.
Nice. Good memories of that. 1970s.
I don't have any memories.
Probably.
I was there.
No, they opened for, what was it called? The cathartic puke.
The cathartic puke.
Nodes of contagion.
Is that heavy metal? Cathartic puke?
Yeah, cathartic puke is pretty heavy metal.
Probably.
Followed by James Taylor.
Okay. Don't know James Taylor.
I know.
Was that Fire, Wind and Rain?
No, Fire and Rain.
Earth and Wind?
Trust
All of the
still
above.
Keep going, dig.
plaster
Keep
of
digging.
and bankers'
Yeah.
bonuses.
And they're sticking with
She's
most of the
cutting
plan,
red
Tom.
tape.
Tom, they're sticking with most of the plan. Let's face it. It's just the top income tax bracket that they were going to cut that they're not going to cut anymore.
I mean, folks, we were exhausted with our great team from last week. And we got through the weekend with this nonstop, frankly. And here we are.
Well, it has to
with
stop.
all the data.
It's continued into Monday morning. Good morning to you all. Your equity market just about positive on the S&P 500 as we kick off Q4. Kick off Q4 with equity markets shaping up as follows on the S&P 500. Futures just about positive, up 1/3%, up 11 points on the S&P. Yields lower 7 basis points, 375.64. Coming up, Dan Skelly of Morgan Stanley. This is Bloomberg.
The market was already worried about global growth. It was already worried about UK fundamentals.
Things are pretty unsustainable at the moment, and it's all tied to policy officials raising rates.
I would love for Powell or someone to come out and say, hey, we're just cleaning up the mess made by fiscal policy.
This is not the first time we've seen these kind of movements, and they never seem to be fully priced in. Can we have a bear market rally? Sure, absolutely. 8 to 10% in this kind of environment is not unheard of.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Hello, Q4, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures just about positive on the S&P. TK leaving behind an ugly Q3.
Ugly Q3, and many people saying it continues into Q4, and it's hugely data dependent, and this is the mother of all data dependent weeks. The other thing is we need a roadmap of how the esteemed British government gets back from Birmingham to London.
Now that's
Did I do that
Birmingham
okay?
to London.
Birmingham
Night, yeah, absolutely killing it this morning.
You take a plane or a train?
You take a train.
Train. Okay,
you take a train up from New Street down to Euston.
Very good.
If that works out for you. I'm not sure how much that costs anymore. Anyway.
They're probably on strike.
You want to just keep going?
No, I think we're done.
Okay, good.
We're done. The feature of last week, Jim Bianco of Bianco Research, high volatility, poor liquidity, financial stress. That was the bond market.
And that's the reason why you're seeing the concern trickle into all the other markets, because that is the full faith and credit. And that's what we were hearing, just now from Sebastian Gailey, this idea that if the risk is in the sovereign debt complex, how does that trickle out into the rest of the market that is used to relying on low yields and gains in the sovereign market to fuel some of the gains elsewhere?
And if we are going into recession, Lisa, Tom, are bonds going to behave like you'd expect bonds to behave?
No. As simple as that, and we're going to have to watch them. The volatility in the U.S. market is tangible. In EM, Damien Sassauer would say it's incalculable. John, I want to go to the United Kingdom, and we mentioned standard deviation, and the basic idea here is how much has Truss made back in the last couple of days? She was -6 standard deviations.
I think
she's made it back. Teen sweets is the mathematical
tremendously
word.
difficult to strip out the Bank of England's action in that.
Yeah.
And speaking to the team in the UK here at Bloomberg on the Bank of England, David Goodman and co, I think it's fascinating to see the Bank of England come in, announce a 65 billion sterling operation, Lisa, but only have to spend something like 3 to 4. Just gives you an idea of how powerful central banks still are when they do start talking about stepping back in.
Okay, so now the question is, will policy cooperate so that they don't have to spend that? Because the fear is if they actually spend all of it by the end date of October 14th, when this planned exercise is going to be over, then what? Does it become a spiral where they have to keep fueling it? And still there is this loss of confidence by international investors.
It was the question of last week, can these banks, these central banks, do something about addressing financial instability and at the same time do something about bringing inflation back down?
Theoretically, you can't do that. What they have to do is maintain credibility, which is a baloney word. I mean, the chancellor this morning is trying to maintain credibility, I believe. But they got to maintain credibility, and that is sell the message. Maybe we'll see that this week. Are they in a quiet period this week, or do 8 people speak this week?
What, the Federal Reserve?
Yeah.
We'll hear from Williams a little bit later.
Everyone's speaking this week.
Bramo's going to go through the Fed speak in just a moment.
I actually held off on some of the Fed speaks. I figured everyone just knows. Everyone speaks. They're all going to say something.
I thought you'd give us some Fed speak, no?
Well, I could go through the week. Go ahead. I mean, I'm going to do it tomorrow. We have a lot of Fed speak, Williams.
You seem really pumped up about this week in the Federal Reserve.
What exactly is it going to do to change the market dialogue right now? Honestly. Yes. I mean, you
fired up about the Fed speak?
It's just, I actually gave it a lot of thought this morning. Should I talk about all the Fed speak, or does it even matter anymore? Because right now, unless they come out and they say, we are now more concerned about financial stability, we're more concerned about some of the weakness that we're seeing overseas, what difference is it going to make?
TK wants to know, will you include the bond auction in the brief.
Yeah, that's important.
That's going to stick.
That's important.
That's going to stick. Okay. Let's whip through the price action for you.
Save us.
On the S&P 500 and beyond. Credit Suisse too. That stock in Switzerland's down about 7% right now. We'll pick up on that story a little bit later. Futures up 0.4% on the S&P 500 after last month delivered an ugly loss on the S&P. We were down about 9%. The third straight quarterly loss on the S&P, longest losing streak going back to 2009. Ugly. Yields are lower by 7 or 8 basis points on a 10-year, 375. And Lisa, euro dollar negative 0.25%, 97.78.
Yeah, I think it's important to say that right now we're looking at the possibility of 97.78. And what we're looking at is the fact that we're not seeing any rollover in inflation, even though you are seeing this hawking up of a ECB rate hike and more aggressively hiking rates at that. Still 10% year over year CPI for the euro region. And today and tomorrow, euro area and EU finance ministers are going to meet in Luxembourg. Our own Maria Tadeo is there with them to talk about what to do about this, especially because you are seeing slowing growth. How much policy can they really come out with? What would a price cap to oil, to gas, to natural gas actually do to lower some of the inflationary pressures? Wednesday, OPEC Plus meeting to decide potentially how much to cut production. This could be the biggest cut in production going back to March 2020, to the peak, to the heart of the pandemic. Also notable to say that OPEC Plus is meeting for the first time in person since the pandemic's onset. There is some speculation, some questions around whether the Russian oil minister is going to join them. And you are seeing a pop in crude today, although you have seen a real steady downtrend as people get more concerned about a slowdown in economic growth. And on Friday, that is the key event, U.S. non-farm payrolls. The high expectation on Wall Street is for 389,000. The low is around 200,000. How much does it really matter unless we get down to what we were talking about earlier of a potential of 100,000 print for several consecutive months? That's what Bruce Kasman was saying would be necessary for the Fed to pause. How much does the unemployment rate really need to go up for the Fed to take a second look at some of their tightening plans, John?
Williams at 310 and Bostic at 905 this morning.
Thank you.
Lisa, thank you. Thank you very much.
Keep doubling down on that.
Dan Skelly in the studio with us, Tom, the head of market research and strategy at Morgan Stanley Wealth Management. They watched the Fed speak, TK.
I don't know. No, I don't watch it. It's all. I just can't.
You don't read the Fed speeches.
No, I sort of glance at the headlines and the analysis from John Ferro, and I move on. I'm sorry. I mean, it's like the beige book.
You don't read the beige book?
No, I never have. Richie Amarone, the late Richie Amarone, was brilliant at reinventing
he was fantastic, wasn't he?
Beige book. He called it the orange book that was valuable. Like you actually learned something.
Let's learn something from Dan Skelly. Dan, fantastic year. Notoriously bearish through much of 2022. It's worked out almost perfectly. We're all wondering now for you, what are the preconditions that you want to see? The checkbox, check, to add equity exposure.
Sure. And good morning. And by the way, it's great to be in studio all together, having the band here back together.
So I'm sick as a dog, but continue.
It's been 2 years, Dan. It's been too long.
I'll inch my chair.
Everyone else is too.
John, to your question, look, we've done a lot of damage, obviously, in the third quarter and last month. But notably, we're still trading around the June lows. But notably, all of that work has been rates, right? We haven't seen the earnings reflected yet. And so talking about Fed speak, I think investors want to hear management speak really at this point and really kind of throw in more of a towel. So number one is earnings. Number two is PMIs. We haven't seen that contraction yet. And number three is jobs. And we have a big update coming this week, but we just haven't seen that rise in the unemployment just yet.
I've been waiting for a research note like you've got, which is real simple. Look at dividend growers. How did dividend growth change? How does dividend growth change given dampened economy, dampened revenue growth, and then down the income statement? How does that filter into the dividend growth decision?
Well, when you look at companies, M&A and deals have been really dried up this year. So I think you look at companies being more defensive. Buybacks has obviously been a huge use of capital this year, and dividends continues to be a huge use of capital, and investors are rewarding dividend growth wildly this year.
How many basis points pickup do you have there with dividend growth versus the riffraff that's out there?
I mean, when you look at kind of income styles, dividend growth styles, they're down kind of mid-single digit, high single digit this year versus the S&P down 20% plus.
So, Dan, Tom said something earlier at the start of the show that are bonds going to, and John asked him, are bonds going to react the way that they normally do in a downturn where they gain value, people pile in? Tom was saying he doesn't think so. A lot of people agree with him. Do you?
Inflation is still stubbornly high. And so if we have kind of a plateauing or a moderation in inflation, I think bonds could certainly act better. But Lisa, to your point, that was the case earlier this year. The first 4.5 months of this year was all about stagflation. And so you saw both stocks and bonds down together. It got a little bit better over the summer. Then, as you've seen, again, bonds have sold off quite rapidly. So I think around the 4% level on the 10-year, there is more value in bonds here to do their job in a volatile environment.
Spoke to Mike Wilson, your colleague, our good friend, in the last couple of weeks. And I asked him whether you guys start to get uncomfortable when everyone starts to share your view. When you start to see some of the big bulls on Wall Street capitulate, and Marko Milanovic came about that close on Friday, do you feel uncomfortable when everyone starts getting comfortable with your way of thinking?
You do, but your thesis is still in check, right? So when you think about the call Mike made, and we joked a few months ago about that lonely island in
sure.
January.
Everyone's on board. It's overflowing.
You know, what, to your point, Jonathan, you look at the sell side, you look at the buy side, mutual fund cash levels, hedge fund net exposures, and we have a particular advantage because Morgan Stanley is the biggest prime broker out there. So everyone is inching.
A sales call for you?
We're here in studio. Why not?
Thank you. Okay.
You can start whipping out a PowerPoint.
No, but to Jonathan's point, we are growing a little bit more nervous about that consensus trade, but that doesn't mean things can't go lower still.
Credit Suisse cut this morning. I think Citi did as well. Jonathan Golub-Tom has gone to 38.50 for year end, down from 4,300.
Big change. When the facts change, I change. I believe
Everyone's
that's the Golub mode.
Gotten on board. That island is very crowded right now. You were the first one there, though, Dan. It's good to see you. Dan Scully there at Morgan Stanley.
Mike
Thank
Wilson
you, sir.
nailed it. And just
Fantastic.
as importantly, Ellen Zentner was transitory, and on a dime, she switched.
Shifted to a tighter Federal Reserve. I keep saying this to everyone. If you started the year bullish, nothing wrong with that. The surprise has been the war in Ukraine, a massive, massive move from the Federal Reserve. Think about where we started 2022. In the year-end projections from the Fed, and I keep repeating this because I think it's worth going over, they had 90 basis points year-end. And in the S&P, that was the dot, 90 basis points year-end in the S&P. Lisa, everything changed.
The fear is that now people have changed to this idea of a stickier inflation and the Fed needing to overshoot with respect to the rate hikes. And what if the facts are changing on the ground just as quickly in the other direction?
On the earnings side of the story as well, something we'll keep focusing on. Coming up shortly, Sam Linton-Brown, the head of global macro strategy at BNP Paribas. Looking forward to that conversation. Futures positive, 1/3% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. British Prime Minister Liz Truss has done a U-turn. She's dropped a plan to cut taxes for the highest earners just 10 days after it was announced. It's an attempt for Truss to fend off a rebellion from lawmakers in her own Conservative Party. Chancellor of the Exchequer, Kwasi Kwarteng, says the tax cut had become a distraction. Truss and Kwarteng will be hoping to end days of market turmoil that followed his fiscal package. The price of oil jumped today. There are indications that the OPEC Plus alliance may slash production by more than 1 million barrels a day to revive plunging prices. A cutback of that size would be the biggest since the pandemic. OPEC Plus meets Wednesday in Vienna. In Brazil, the presidential election is headed for a runoff. On October 30th, voters will choose between President Jair Bolsonaro and his leftist rival, former President Luiz Inácio Lula da Silva. Now, Lula had the biggest share of votes on Sunday, but fell short of the absolute majority he needed to win. On the first day of its new term, the U.S. Supreme Court will hear a landmark challenge to the Clean Water Act. A couple is suing the Environmental Protection Agency, hoping to limit its authority in protecting waterways and wetlands. The plaintiffs are backed by a long list of industry groups, including the National Association of Home Builders and the American Petroleum Institute. Shares of Credit Suisse fell to a record low today, and the cost of insuring the bank's bonds against default climbed to a new high. In a memo to employees, new CEO Ulrich Korner said Credit Suisse has a strong capital base and liquidity position. He will announce a turnaround plan on October 27th. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
I think the ECB has the problem that they can't fix this problem on their own. Or if they try to fix it on their own, they're going to make the problem worse. They need the support of governments. Governments are the ones that can raise supply or can help raise supply of energy and therefore lift supply overall and bring inflation down.
Big problems in Europe. We'll talk about those problems in just a moment. That was Christian Schultz there, the Deputy Chief European Economist over at Citi. Live from New York, good morning to you as we kick off Q4 and the month of October in this market. Futures just about positive, 0.5% on the S&P 500. The equity market down and down hard through the month of September. Another quarterly loss for Q3. Every single quarter lower through the year so far. Yields are down 10 basis points now, 372.83. Euro dollar negative 1/3%, 97.72. Bit of feedback this morning on Twitter, Tom. No mention of Tottenham this morning.
No, we're
just
quiet
pretending that never happened.
You mentioned the things that are changing here as we move into October, and one of them is Arsenal keeps winning.
I like that, Lisa. Is it a quiet period for Tottenham fans?
Quiet period
is that
for
what this
Tottenham
morning
fans.
is?
Very good.
Okay.
She's learning. We were supposed to be at the derby. We weren't. You and I failed.
I know.
We
failed a lot this year, Tom.
Yeah, well, we were supposed to be there. What an interesting day, and it is about the greater economies of the world. One of the great facts is Madrid has the best museum in the world. It is called the Prado, and it is a must visit, and that speaks to the healing of tourism in Spain. Spain is booming, like Paris, like London. It's been a very strong story, but with it too, and up to 10% inflation. Maria Tadeo now with the Deputy Prime Minister of Spain.
Tom, thank you so much. And we are joined, of course, by Spain's Finance Minister and Deputy Prime Minister, Nadia Calviño. Buenos dias. Good morning.
Buenos dias.
I have a lot of questions about Europe, but first of all, I have to get your thoughts on what's going on in the UK, because today we've seen a huge U-turn from the UK government. Markets really flipping on this country. I don't want to create trouble, but when you look at that country, is it a message in terms of what not to do going into the winter, perhaps, for you?
I think it's very good news that they backtracked, in particular when it comes to the reduction of the taxes on the wealthiest parts of society, because it really shows that it's not only a matter of financial stability, it's also a matter of fairness. We're all confronted with the challenge, how to contain prices, how to support our economies, how to fund our public services, and we need to ensure that we have fiscal sustainability, financial stability, but also a fair distribution of the impact of the war.
So that means essentially tax the rich more, to some extent.
That's what all international institutions are recommending, and this is what the Spanish government has been defending when it comes to the international framework. Not specifically or not only this dimension, but generally we need a fair tax system. We need to avoid a race to the bottom, which at the end of the day is making all of us poorer, when we need stronger states to also face the blackmail coming from Russia.
And that's a message perhaps for Liz Truss, but I don't want to create trouble intentionally perhaps between the EU and the UK. So let's talk about Europe. It seems to me there's forces that are pulling from different ways. You have demand destruction, which seems to be working. At least the message is resonating with Europeans. The storage is up, but you have an escalation in the war and an escalation in the energy war. In your view, what's the outlook for Europe going into the winter?
We're at a very challenging moment, no? Because the war is entering a new phase, or so it seems. We also see that Nord Stream supply was cut 1st of September. The positive element here is that prices are not continuing to escalate as they did in past months when Putin was using the energy blackmail. No? So I think that actually what we see now is that the storage level is appropriate, that Europe is having a stronger voice when it comes to international energy markets, and we should continue in that direction with a response which is united, determined, and also based on solidarity between the different member states.
When you say solidarity, last week Germany came out with a 200 billion euro package to save their households and companies. Is that solidarity for you?
Well, I understand that each country is subject to a different kind of challenge. No, I mean, the increase of energy prices hit Spain maybe before other countries because of the flexibility of our electricity markets. But now we see that inflation is already going down in Spain, whereas we see in Germany that the situation is very different. They have a higher dependence on Russian gas and oil. And so we have to be respectful of the different specificities of the different countries and ensure that our framework and our rules are fit for purpose in the sense of allowing for this flexibility in terms of the response at the national level, but reinforcing the European level instruments so that we ensure fair treatment of all citizens and companies throughout the EU.
So to reaffirm that message, as a final question, on Wednesday, the Spanish Prime Minister Pedro Sanchez will meet with the German Chancellor. Is he going to convince the Germans to drop their opposition to this price cap on gas?
I hope so. Well, definitely Spain, for the last year, Spain has been pushing for a European response. We've been pushing for price caps. We've been pushing for joint purchases, an overhaul of the European legislation. We managed to have the Iberic exception, which is allowing us to have a gas price cap between Spain and Portugal. And this is already saving Spanish citizens and companies more than 2.5 billion euros, and it's proving to allow us to have lower prices than other countries. It has even decoupled the wholesale gas price from the Mediterranean, the Iberian gas from the TTF reference, which shows that we can act and we can change things if we act together. So I am sure this will be discussed in the summit between Spain and Germany on Wednesday, and I hope we do convince Germany to move in this direction.
And it's interesting how the diplomatic ties are changing between Madrid and Berlin, perhaps growing closer over the past 3 weeks, in particular when it comes to potential gas supplies coming in from Spain. But you also make it clear it has to go both ways. Nadia Calviño, thank you so much for joining us on Bloomberg TV this morning, and we hope to see you very soon, of course, in a few hours' time.
Yes, indeed. Thank you, Maria.
Thank you so much. And guys, back to you.
Maria, thank you. One of the best. Maria Tadeo there, alongside Nadia Calviño, Spain's Deputy Prime Minister. Are we uncomfortable with how easy some of these foreign leaders are making comments about fiscal policy in the UK? And we've heard that from Spain now.
Well,
I've heard that
from the IMF.
The US government. Yeah. I've heard it from the IMF. They seem to be very, very open about how they feel about UK fiscal policy.
I am with the crew where most of it's way out of line. And frankly, if I'm in front of Georgieva at the IMF meetings, it's my first question. Why
the UK and why not closer to home?
Why the UK? You got a few other headaches to worry about, but just walk us through the process that generated this letter. Can we agree that letter was the catalyst for all that went on?
There's a larger question about whether markets are dictating fiscal policymakers' response and whether they're getting the okay to come out pretty aggressively against this move because of the move in markets and because of the threat to financial stability.
I don't remember many governments coming out and commenting on US fiscal policy in quite the same way.
Exactly.
Markets liked it, but markets liked it at the time.
Do they like it now?
But that's the issue. How much does that shift the narrative completely?
Live from New York. Good morning to you. This is Bloomberg. Live from New York City this morning. Good morning to you. Here's the price action on the S&P 500 and beyond. Just about positive at 0.4% as we kick off Q4 and the month of October. Futures up by about 0.1% on the Nasdaq 100, leaving behind a quarterly loss. And in the month of September, down 9 full percentage points on the S&P. Can we find some gains here going into earnings season? Bramo's going to go through that for you in just a moment. I want to talk about the bond market. 2s, 10s and 30s for a 9th consecutive week. Yields higher on a 10-year at the front end. 12 months ago, sub 30 basis points. Right now, 415.26. We come in 12 basis points on a session. So on the day, as we kick off a brand new quarter, yields in and yields in big time. That's the bond market. I want to finish on foreign exchange. Sterling, cable. Cable looks like this right now at about 111.89. We can call it 112 off the back of...
Yeah, we can.
Can we call it a U-turn, Tom?
It's a U-turn
from the
yes,
Chancellor on
I'll
one
go with
specific element of the overall mini budget, and we can build on that a little bit later. But sterling last week from 103.50 through 112 briefly. Tom, believe it or not, biggest week of gains for sterling against the US dollar going back to March 2020.
And for those keeping scores, we look at equities, bonds, currencies, commodities. What's so important here, John, is bonds don't move like FX. So to equate sterling moves with gilt moves is maybe amateur hour.
Couldn't agree more. And there's a lot of dates in the diary for this month. I'll pick two. At the end of the month, we'll hear from the ECB. And in the middle of the month, will we hear from the Bank of England with that gilt market operation they announced last week, set to expire, set to end on October 14th. A couple of things to think about. That's the cross-asset price action. Sterling, 111.98. Let's get you some single names. Let's say good morning to Bramo. Morning, Lisa.
John, you were saying that October 14th is going to be one of the most important dates of this particular month. It will also be important because of the earnings kickoff from JP Morgan. We're getting a little taste of what's to come potentially. And will it be ripping off the Band-Aid that we heard from Lori Calvasina, or is this just the beginning of what's more to come? Tesla shares down 5.5% after reporting that deliveries for the third quarter were disappointing. Why? Because of shipping issues, some of the supply chain issues that have not abated still, even though here we are. Then, of course, you've got Blue Apron, some of the pandemic darlings that have really seen their bloom come off. But those shares down, gosh, nearly 19% at this point ahead of the open after reporting preliminary third quarter earnings that missed estimates. Again, you have to wonder if this is the response to an earnings miss. What's been priced in? How much earnings pain have we actually acknowledged in the valuations of some of the U.S. equities? And then I want to take a look at Nike. And they reported earnings after the bell on Thursday. On Friday, a brutal show. More than 12% decline in the shares, the biggest one-day loss going back to 2001. And here we are, pre-market still lower. So even with all of this, people aren't seeing the value. And we did see RBC Capital move away, Tom, from their overweight of Nike because there could be more of these downside surprises. This is also with a lot of the inventory build that you're seeing across retailers that will mean lower prices, but will also mean much smaller margins.
Lisa, thanks so much. Greatly appreciated. Futures up 15. Dow futures up 166.
Thanks for that, Tom.
Someone, John, paying attention always to Dow futures is the star of Keeping Up with the Kardashians. Kim Kardashian, in equity, in bonds, currency, commodity, and was in crypto.
The
Mr.
SEC.
Gensler reports.
The SEC. So I'll stick to the press release from the SEC.
Sure.
Charging Kim Kardashian for unlawfully touting crypto security. The press release, and I'll read you the first couple of paragraphs so you can all get up to speed. The Securities and Exchange Commission today announced charges against Kim Kardashian for touting on social media a crypto asset security offered and sold by Ethereum Max without disclosing the payment she received for the promotion. The press release goes on to say Kardashian agreed to settle the charges, pay $1.26 million in penalties and interest, and cooperate with the Commission's ongoing investigation. The second paragraph, Tom, reads as follows. The SEC's order finds that Kardashian failed to disclose that she was paid $250,000 to publish a post on her Instagram account about EMAX tokens, the crypto asset security being offered by Ethereum Max.
This is brand new, but what I'm going to go to is the key idea. And, you know, we make jokes about this, but this is serious stuff. And the answer is celebrities and influencers. And that's really interesting in a modern. Is this the first time this august institution, Arthur Levitt's SEC, has gone modern?
And how much they're using Kim Kardashian as the key poster child for don't do this, right? I mean, how much are they going to try to go hard on this so that they do set a precedent when it comes to social media and influencers?
So there's two issues at play here. One is social media and how social media is used and what you need to disclose when you put some kind of post like this one on, say, Instagram. The second issue, picking up on what you're both talking about here, and we've talked about it on this program, celebrities touting any kind of financial vehicle, security, asset class makes me deeply, deeply uncomfortable. And when I see those interviews in the financial media, I absolutely despise them.
What does this mean, John, for Mr. Musk? Is a corporate officer, Twitter's publicly traded company, so is Tesla. But is he a celebrity? Is he an influencer when he's using social media? I have no idea. I'm speaking.
Well, the key part here is whether you disclose that you were paid to publish the post on the Instagram page. I mean, that's the key issue at play here, the fact that she was paid $250,000. But I keep going back to something I've said repeatedly. If you see celebrities on TV touting any kind of financial security, asset class, whatever it might be, that is merely only about the media trying to get clicks, trying to get eyeballs, and it drives me absolutely insane. Now, let's leave the SEC story to the one side, and we can pick up on this a little bit later, and let's talk about the general media. How the media covers the likes of crypto, any new fad when the SPACs make a comeback. No, we should get going about this because I think it's a big, big problem. The media also has a responsibility not to chase the latest fad in financial markets just to get eyeballs and clicks and to get the audience up for a couple of weeks, a couple of months.
You're 100% correct, and what upsets me is not so much people that aren't getting paid $250,000 to do whatever, but are we showing the academics and the people really, really thinking about all of this digital stuff? And I would suggest the media runs away from that because it's boring, like the show. But you know,
thank you, Tom. That's the promotion for the show.
That's the promotion for the show.
We can do more SPACs and crypto if you like.
But in crypto, we got to get some adult entertainment out there. You know, like Raphael Auer at BIS.
On a serious note, just to put a bow on this one, Kim Kardashian failing to disclose that she was paid $250,000 to publish a post on her Instagram account about EMAX tokens. At least probably won't be the last. This issue certainly isn't new. We've seen this repeatedly on a whole range of circumstances, and this is the latest.
Misrepresentation and acting in an appropriate manner, considering that. And that is an age-old kind of credence, and that's what we're going to be looking for from the SEC.
We say thank you to Deborah Cunningham as we diverge to that important SEC statement. Ms. Cunningham, of course, Global Liquidity Markets CIO at Federated Hermes, and we're absolutely thrilled. It's a perfect time to speak to her about liquidity. Deborah, I'm going to cut to the chase. I don't care about the Fed right now. I care about the operation of the global fixed income markets. Is there liquidity, particularly in the short-term space?
Well, first of all, let me tell you, I was completely entertained by the discussion you just had on Kim Kardashian and celebrities advertising and promoting products, especially financial products. Unlike dealing with the National Enquirer, dealing with the SEC is a completely different ballgame, and I think they need to learn that. So thank you for that. As far as the bond markets go, the global bond markets, the global liquidity markets, there is liquidity in a constrained sense. It is there for both buying and selling. There are plenty of securities out there. It's price action. You got to make sure you know what the value is that you're looking to purchase, that you're looking to sell, because that's where the question marks exist right now. There are market makers, but you can, in some instances, drive a truck through the bid-ask spread. We're going to be delicate here, Ms. Cunningham. I want to be very, very respectful of the heritage of Federated Hermes. If a given larger bank is visible with challenges and trust, how does that change the plumbing and the mechanism of a troubled major bank with people like Federated and your good competitors out there? How does that give and take on a daily basis change with any given bank challenged? Certainly. Well, there are two main ways of dealing with our large banks here in the United States as well as globally, and that is both from a credit perspective as well as from a counterpart perspective. From a credit perspective, then the second that we see chink in the armor, the second that we see problems from any kind of loan loss reserves, any kind of issues with regard to their their earnings and their profitability, those types of issues then will require us to no longer continue funding them. So from a credit perspective, the ability for us to lend them money in instances where there is deterioration from a credit process exists. On the counterparty side, depending upon what types of trades you're doing, DVP, other types of, sort of riskless trades where you are looking to the counterparty for some form of execution, but you're also not giving them anything until you receive something in return simultaneously. There's a little bit less of an onerous issue, less of an onerous process under which we review who our counterparts are, who versus who our those that we extend credit to would be.
Deborah, based on where we are right now, how concerned are you about some sort of liquidity event, about the withdrawal of liquidity from both a fiscal and a policy and a monetary policy stance that everyone seems to be talking about and preparing for?
I think we still are not dealing completely with where we are from a rate perspective. So many people that are in the market today think zero rates are normal, and they're really not normal. 2%, 3%, I'm not sure what's normal in today's environment. But I think that it is no longer a reality to think that 0% is normal. So you have to get used to that new normal, at which point liquidity then becomes a bit more of a front and center issue. You can't deal in a marketplace that doesn't have equal buyers and sellers at a price that's agreed upon on a pretty rational way. So I think you're in the midst of discovering that. We're certainly still seeing, some bond market revolt. I don't know that much of it is because of what the Fed is doing from a standpoint of rates or from a standpoint of quantitative tightening. The 90 billion that they're doing per month, 90 plus billion they're doing per month in the marketplace, actively reducing their balance sheet. But it's all contributing to a little bit less from a market-making capability for some players in the market.
Deborah, I've got to squeeze this in. I spoke to a lot of people in fixed income last week, and overwhelmingly the consensus was that the pension industry in the UK dominates the gilt market. It's a very unique space. What's happened there in the last week probably won't happen elsewhere. Would you agree with that?
I would agree with that. In fact, I was in London last week, and I was watching it unfold, and I thought how different this is from the U.S. marketplace. There are, obviously some similarities and comparisons, but the issues that were taking place from a pensions LDI perspective in London are unique to that area of the world. They are not something that we should be experiencing in the United States at any point.
Deborah Cunningham, fantastic to catch up with you as always. A federated Hermes on a bond market that has experienced a wild ride for the year so far. The bond market at the moment, though, is not behaving like a bond market that's about to go through an economic downturn because, Lisa, if it were, we'd be expecting yields to be going much lower, not testing 4% like they did last week.
Unless we're talking about stagflation, unless you're talking about persistently high inflation in the same time that you're seeing growth decline, which is right now the big fear.
A massive fear, captured maybe by corporate America slowly and then more quickly and then all of a sudden all at once. The S&P 500 this morning. Good morning to you. Just
so
about
optimistic.
Positive. Up a half of 1%. We're just sitting even closer. It's getting closer and closer. From New York, this is Bloomberg.
I think it will be a pity if in Europe we don't have investment banks and we have to rely only on US banks. European clients want, in the end, stable counterparts that are there always, not only in good times but also in bad times. And we've seen that, often when you have a crisis, there is a tendency to concentrate on your own market, and this is true for American banks also.
That was Lorenzo Bini-Smaghi there, the chairman of Societe Generale. Live from New York City this morning. Good morning. Your price action shaping up as follows on the S&P 500. Just about positive, a half of 1%. Credit Suisse getting absolutely hammered this morning, guys. TK, we're down by 7.8%. in Swiss trading.
Continuing from the end of the week, and I do want to say Bini-Smaghi, they're hugely qualified to opine here on the state of EU banking. Also on EU banking is Marion Haltermeyer, Bloomberg finance reporter in Zurich, the home of Credit Suisse, and she joins us with a brief this morning. Marion, what is the choice set? What are the options that this beleaguered management has?
That's a very good question. They're going to have to present something very strong at the end of this month to really truly reassure the markets on the state of the bank and whether it can continue existing in the state that it is. Some of the options they've been looking at is, what can they exactly do with this costly investment bank? And so that ranges from, outright spinning it off to just cutting different parts of it. For example, selling the structured products business.
Cutting costs money, Marion. There's a big conversation now about whether they have to do a big capital raise. What are the numbers you're hearing about how much this would cost?
Listen, the ranges are big. It goes from, $1 billion to $4 billion. We're not sure exactly. It's going to depend on how much they actually plan to cut and therefore how much they need to actually fund the cutting. And that's not all going to come from job cuts, for example. So the other thing is that capital raise right now looks very difficult with, the stock at an all-time low.
We were just hearing from the CEO of Societe Generale talking about the importance of the steadiness of a counterparty, the importance of credibility. Can this bank make it till the end of the month when there is some sort of plan released?
Also a good question. I mean, they've been struggling and staggering along this whole year. They've got about 2-3 weeks left just to make it to the announcement, and then after that's a question of whether or not that's even going to assuage the markets and whether they can make it to the end of the year without further announcements. So definitely we'll be on the lookout for more communication from the bank.
How are they keeping their best talent right now?
It's a lot of conversations around bonuses, retention payments, et cetera, but there's been a lot of talent flight over the last 2 years, so it's hard to say, what they've been able to keep and what they'll be able to attract going forward as well.
Marion, we need to be respectful of the ongoing concern that any given institution is, including one in Zurich. In America, it's done different. And the crystalline point was James Dimon of J.P. Morgan buying for $2 per share a beleaguered investment shop in March of 2008. How close are we to that drama in Stade Zurich?
I think you have a lot of voices, a lot of important, knowledgeable voices, including the analysts who cover the bank day in and day out, who have been saying, let's not get ahead of ourselves. The bank is still solid. They have capital buffers. That isn't to say that there might be a takeover offer, but it's not a situation where the bank really needs rescuing at this moment.
Where's your government, or is it diffuse because of the diffuse canton structure and the domestic statehood and nationhood of Switzerland? Is there a regulatory body in charge?
There is the regulators, so FINMA here is actively looking at the bank and has been for the last 2 years, ever since we had the multi-billion-dollar losses, in 2021. And so there's definitely been some oversight and conversations behind closed doors. But I think until we get to a point where the bank is really in a dire situation, the government or the regulators will not step in.
Marion, I imagine we're going to be catching up with you before the end of the month. That's for sure. Marion Hoftemeier there from Zurich, Switzerland, on the latest with Credit Suisse. Banks in Europe have often found themselves in the trap, Tom, of trying to cut their way to growth. It's a vicious spiral that's very, very difficult to get out of. It's a story. We need to be careful. We're not in the rumor business here or anything like that. We heard a lot of rumors this weekend. What I would suggest is it always comes down to regulatory pressure. It's no different than Barbara Conable going over to Nixon on a given night 1,000,000 years ago and saying, "President's over." Where are the regulators to say, continue, or do this, that, or the other, or it's over? I mean, where are the Swiss regulators? They were blind this weekend. The do this, that, and the other could take place at the end of this month when they come out with this strategic plan. Why wait? The capital raise that goes alongside, potentially, and I say potentially this capital raise that goes alongside that strategic plan. Lisa, the complication there are the numbers on the screen right now, 365. 365. That's a big change from where we were 12 months ago.
They're not going to raise that much money for the amount they're going to dilute their existing shareholders, which comes down to this sort of downward spiral. And what do they have to pay up in order to attract new investors? If you have a $10 billion valuation down from what is that, 1/10 or of what it used to be, something like that?
It's a fraction.
It's a fraction of what it used to be. If you try to attract new shareholders, you're not raising that much money to really make it worthwhile.
The message out of the bank over the last week, and here's the quote from the CEO: "I trust that you are not confusing our day-to-day stock price performance with the strong capital base and liquidity position of the bank." We mentioned this a little bit earlier on. When you hear companies come out and need to say those things, they're usually in a pretty difficult spot, and I think it's fair for everyone to say right now, they're in a tough spot.
Also, I mean, if you think about attracting business, it is a highly competitive environment that it's only become more so because there are fewer deals to be had. What is their competitive edge to win those deals, to win the confidence of clients at a time when you're seeing these kinds of rumors swirling and you see a share price that's plunging and you see credit default swaps surging, the cost to protect against a default to the highest level since 2009 to really understand.
What do you make of that, the CDS market, the way it behaves sometimes?
It could be just people using, witches circling at the top of a mountain in order to go.
On us again?
I'm just going to go to Sebastian Gailey. I think that's actually well said.
I think it's worth a conversation, Tom, because I know you have stuff to say
I'm
on this.
I'm not a big fan. CDS, I've seen too many other times where it's just off the mark on a deviation basis versus other more reliable series. I'm not saying, I'm not knowledgeable enough to say don't do CDS. I'm saying I question the slope, the value.
I would argue that this is signaling a high probability of some sort of restructuring that will be a default event. Not necessarily that it will become insolvent, but people are preparing for a wholesale change in a bank that used to be a mainstay, a huge competitor. I mean, when it bought DLJ, it was the leveraged finance king of Wall Street, just to understand, put into perspective the engine of growth that it once was.
And we all know some phenomenal people working at the bank.
Absolutely.
Just reminds me of the Deutsche Bank situation, Tom.
Yeah, I really, yes, exactly. And what this amounts to is the people we talk to as a general rule, folks, are in research and are away from these immense challenges of profit making in certain investment banking and trading divisions.
And have suffered after poor leadership following poor leadership, I would argue, particularly over the last 5 years.
I think it's just absolutely unique. And, we could speculate. UBS takes them out. Deutsche Bank takes them out. They do the cash call that Lisa's talking about. I don't know.
Futures positive, Tom. 0.4%. Kicking off October. And Q4.
It's a strange kickoff.
Isn't it just? Sam Linton-Brown of BNP Paribas is going to join us in around about 5 minutes' time.
For Halloween? I haven't
What's that?
yet.
A bow tie.
I thought we went with T-shirts on as QT.
I don't know.
Well, that's
we
what
got
we
some
did for Halloween.
swag. Maybe I'll go.
Just go around, knocking hedge fund managers' doors and stuff with T-shirts on. QT, boo.
Got to ask the question, well, what happens when the Bank of England takes away this extraordinary support of the gilt market?
The dollar strength that seems to be making its way around the world is something that will likely continue in our view.
The risk is that inflation expectations de-anchor.
We are looking for a recession, sometime next year. The question is, exactly when.
I think we're getting really close to a blink.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We are together with you the first day of the fourth quarter of 2022. John, a slow news day.
A slow news day?
Yeah.
How much more news do you want?
We were overwhelmed all last week, through the weekend, back and forth. And, John, here we are with a U-turn by the British government, essentially, but other U-turns out there as well, including the economic data we see this morning.
The biggest issue for me last week, and I think we're all on the same page when it comes to this, was not the announcement the previous week from the UK government. It was how this market responded to it.
Yes.
Financial stress, the instability, the fact that a central bank had to step back in. I think that's a key feature of this market at the moment, a key fear for many, many people, that we start to see more of that in pockets across Europe and perhaps here at home in the United States.
My theme of the research weekend was many people saying, don't get distracted, as the Chancellor was distracted by tax, by the UK ballet. There's so much other stuff going on that indicates some real tension and concern.
The question we were asking in the last 6 months is, do we have to make a choice between accepting higher inflation or a recession? I wonder if that question has changed a little bit over the last week. Is it now a choice between recession and financial stability or higher inflation for longer?
Well, financial stability is in the calculus right
Without
now,
a
to
doubt.
the IMF meetings. But Lisa and Maria Tadeo's wonderful interview with a Spanish official. The fact is 9% modeled inflation is 10. When do we have CPI here again?
In a week or so?
In a week or so.
Well, this goes to the question of what does the Fed do? What does a central bank do in the face of financial stability? Is the UK playbook, the Bank of England, coming in with not QT like we're going to dress up for Halloween as, but quantitative easing, essentially going back and buying bonds in order to stabilize markets? Can they do that because of what you're saying, 9 to going to 10, going to who knows where in terms of inflation rates?
To get to our important guest, let's frame out the data now, John. And I'm looking critically at 145 print on yen, almost back to the intervention point. I thought sterling would move more off the UK announcement. We'd be 113, 114. It's weaker pound than I
We had a
expected.
sizable move last week.
Yeah.
Believe it or not, a pretty strong week for pound sterling. The feature of this morning's price action that gets my attention again is just how much yields are moving by. Lisa, to see the 2-year down 15 basis points, the 10-year down 14 basis points, not exactly a big morning for market-moving data that would whipsaw this bond market around. But look at these moves, 10, 15 basis points. Is this the new normal for what a volatile Treasury market is going to look like?
And can risk assets really get a bid? Can there be some sort of steady rally if you have such volatility in benchmark asset classes and benchmark rates? And that's, I think, what people are looking for to stabilize before they get some more conviction.
Will bonds behave like bonds, Tom? That's the number one
bonds
question.
behave like bonds. What did you observe in the spread market, Lisa? It's your wheelhouse. What did you see?
So people last week were saying that they're starting to see signs of dysfunction. And we saw that from Bank of America. They came out and they said that they were getting really close to some sort of credit event or at least liquidity event. But what you did see was a slight bid into credit on Friday. So I don't know what to make of a spread market that's sending mixed signals and that perhaps is looking to that blink, that, I don't know, pause, whatever we're going to call it.
First day of fourth quarter, pivot. The VIX is pivoting, still above 30. 31.68. What else, John?
The equity market just about positive on the S&P 500, Tom, leaving behind a pretty ugly month of September on the S&P. We're down about 9%, down on the quarter as well, down for a third consecutive quarter on the S&P. Futures right now, TK, up around about 6 or 0.7%.
In the study of economics, there are points where there is a division. You either get it or you don't in one of those econometrics. Sam Linton-Brown is at BNP Paribas, head of global macro strategy with definitive work at Bristol in economics and in the arch science of econometrics. Sam, what does the econometrics of these markets tell you right now? Can you find a trend? Can you find believability? Or are you making it up every week as you go?
Thanks for the question and good morning. So I think the first trend I'll focus on that we have real genuine conviction and even from here is higher rates in Europe. We think the ECB is going to take policy rates to 3%. And when you look over the past 50 years, Bund yields have only been beneath the ECB policy rate on very few occasions. So we think that Bund yields can rise as high as ECB policy rates, which on our view could take us up to 3%.
Sam,
second point.
Can I jump in? Because you've got to make 1 point at a time, and that's a massive point. If we can get the ECB rate to 3, and Bunds are coming along for the ride, can you share with us where Italy is trading at that point?
This is where the ECB's prevention measures, the transmission protection instrument, is going to be important, and it's also why we don't think the currency or risk assets in Europe will respond in the way that one would typically expect to the rate hikes, because effectively you have the ECB front-loading tightening into what's highly likely to be a recession. For Italy specifically, one of the offsetting positive factors here, though, is with inflation this high, nominal growth is also very high. And effectively, if Italy's nominal growth rate's above its level of yield, debt sustainability concerns should be alleviating rather than getting worse. So we do believe that the ECB can get to a 3% rate without triggering, if you like, those types of significant systemic peripheral spread widening.
Sam, before you get to your next point, I just want to understand the euro in this kind of context, because basically you're having quantitative easing on one hand in order to suppress some of the yields in the periphery, while raising rates to 3%, and a level that really many people couldn't have imagined in recent years. What does that do? How weak does the euro get versus the dollar?
The ECB front-loading into recession is bearish, and the key here is, why is the ECB tight? If the ECB were hiking rates as a result of a better growth backdrop rather than a negative supply shock that was weakening growth, pushing inflation up, then that might be positive. So our view is that this is bearish for the euro, it's bearish for European risk assets. We think SX5E will trade down to 3,000. For euro dollar, we're already at very cheap levels. We don't think the asymmetry to be short at this level is appealing. But that's partly based on our structural dollar view.
So how does the U.S. do, in particular companies, and this has been one of the biggest themes that I read in notes over the weekend, of when does a strong dollar become a problem for the U.S., for U.S. corporations? At what point does it really lead to some sort of protracted pain that causes a Fed response?
That is a question that I believe the market is going to be very focused on over the next 6 months. If you like, along the lines of a Plaza Accord 2.0. The view that we've got here is that it's not on the offing anytime soon. There's a few reasons for that. 3 fundamental and 1 political. On the fundamental side, first, the dollar is not nearly as strong as it was prior to coordinated global intervention to weaken the currency. On a real effective 10%, nominal effective 30%. So still a big gap to close there. Second is the inflation trajectory. The US, prior to the last time you had coordinated action to weaken the dollar, had inflation decelerating, and had decelerated for several months. The battle against inflation had effectively already been won. This time's different. Third point there is the US were cutting rates back then. So it'd be incongruous to have a Federal Reserve hiking while there was global coordinated intervention to weaken the dollar. There's also the political point, which from where you're sat, I'm sure you understand better than I do. But given how important inflation is as a topic into the midterms, the probability of Biden effectively agreeing to transfer purchasing power from US consumers to consumers elsewhere in the world, we think is a very low probability.
Sam, next move of the ECB, end of this month. How big are you expecting that hike to be?
We think they'll go 75 basis points, effectively what the market already prices. This is an ECB that understands they are behind the curve. And in contrast to the US, inflation is yet to decelerate off of the high. So it's an ECB faced with a very high level of inflation that's likely to remain here, even with some of the fiscal support that we've seen that pushes down the near-term trajectory a little lower. That fiscal support's also key for the medium-term outlook. It's not going to stop a recession now, but it might mitigate the severity of it. And in the medium term, it will support growth. In turn, it will support medium-term inflation, which requires the ECB to do more.
Hey, Sam. Awesome, as always. What a call. Sam Linton-Brown there of BNP Paribas. That's what's going to make a market. Someone on one side thinking we're going to get to 3%, Tom, on an ECB rate.
Who's got the crystal ball? I don't. All I can say is the animal spirit, the technology overlay of Europe just isn't there. By the way, there's a war. So maybe Folkers Landau, Deutsche Bank says there's a lot of government spending that boosts up nominal GDP, but I can't go there yet.
I'll say this up front, Lisa. I didn't expect to see the 10-year at 2%. Over in Germany, so I'm not going to sit here and say I've got conviction that we're not getting to 3 because we got to 2 in a way that I didn't imagine.
There is an issue, though, here about the new playbook. Is it to hike rates on the front end and buy bonds in the long end? Basically, are we all becoming Japan? Is this all going to be a massive exercise in yield curve control as central banks try to engineer perhaps what isn't going to be a complete financial crash while also mitigating inflation? And can they have their cake and eat it too? I really do think that's one of the main questions emerging after the past couple of weeks.
I couldn't agree more after what we saw with the Bank of England.
Exactly.
I would argue that it started with the ECB. The moment the ECB came out and talked about a rate hiking cycle, and we were all waiting for this vehicle, this mechanism to keep yields down in Italy. How do you buy bonds, get rates up, attack inflation, and do something about financial stability all at the same time?
And juggle with your left hand.
I mean, ridiculous.
I looked at that this morning, and I think Italy is a really important point of study. I have real trouble with the we're becoming like Japan scenario. It's such a unique story in Japan. I just don't think it's comparative.
I think when it comes to the intervention, I think that's the point Lisa's making. And Lisa, when it comes to the intervention that the BOJ is making, will others have to follow?
Will you have to dampen market discovery mechanisms yet again in order to achieve goals that are incredibly difficult to achieve? Some might say impossible.
Price discovery, this was the point we were making last week. How can you price risk when we're having great difficulty pricing the risk-free asset? Again this morning. And up 10 basis points, down 10 basis points.
How do you price risk when there might be the ultimate put of policymakers stepping in?
The 10-year right now, 370. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. British Prime Minister Liz Truss has done a U-turn. She dropped a plan to cut taxes for the highest earners just 10 days after it was announced. It's an attempt for Truss to fend off a rebellion from her lawmakers in her own Conservative Party. Chancellor of the Exchequer, Kwasi Kwarteng, says the tax cut had become a distraction. Truss and Kwarteng will be hoping to end days of market turmoil that followed his fiscal package. The price of oil jumped today. There are indications that the OPEC Plus alliance may slash production by more than 1 million barrels a day to revive plunging prices. A cutback of that size would be the biggest since the pandemic. OPEC Plus meets Wednesday in Vienna. In Brazil, the presidential election is headed for a runoff. On October 30th, voters will choose between President Jair Bolsonaro and his leftist rival, former President Luiz Inácio Lula da Silva. Now, Lula had the bigger shares of votes on Sunday, but fell short of the absolute majority he needed to win. Reality show star and entrepreneur Kim Kardashian will pay almost $1.3 million to settle allegations that she illegally touted a crypto token. Now, according to the SEC, Kardashian used social media to promote a crypto asset security offered by Ethereum Max. But she failed to disclose that she was paid $250,000 to do so. And TV channels owned by Walt Disney are back on Dish Network after a weekend blackout that left millions of Dish customers without access to networks like ESPN and ABC. In a statement, Disney said it has reached a tentative agreement with Dish that reflects fair market value for its content. I'm Lisa Mateo. This is Bloomberg.
Can we have a bear market rally? Sure. Absolutely. 8 to 10% in this kind of environment is not unheard of, and it does provide you an opportunity if you're short-term in nature. I still think U.S. stocks for the long term
Marvin Lowe there, the senior global macro strategist at State Street, live from New York City. Good morning to you. Futures positive on the S&P 500, positive by 0.5%, climbing higher by around about 19 points on the S&P. In the bond market, yield shaping up as follows. A 10-year down by 12 basis points, 371. A 2-year down 12 to 4.155%. Asked the range of guests last week, will we still be doing QT at the start of 2023, Tom? Will we still be doing QT at the start of 2023? I got a yes from Subhadra Rajappa of SocGen. I got a yes from Lotfi Karubi of Goldman. I got a yes from Greg Peters of PGIM. I got a I'm not sure from Mohammed Al-Arian.
Yeah,
very much on the fence, wondering whether that can actually continue, given the financial stability concerns that are starting to bubble to the surface a little bit more.
And what Dr. Larian's talking about there is the data dependency and the arch game theory that every central bank has to keep their options open. And one of them is keeping people guessing about this, not making a decision.
A line of the week last week, bond vigilantes are back.
Yeah, I saw that.
Very cool.
And we have perspective on that now from the gentleman of the vigilantes. Edward Yardeni joins us, president of Yardeni Research, but far more than that, decades of study of Wall Street. We've never seen this. Yardeni's never seen this. We get a brief this morning. You call it a bearish opera, and on we go with the media. How do you sort out Act 1 from Act 3? How do you figure out what's going on if everyone's speaking Italian?
Yeah, well, the idea of the opera came to me on Friday when Fed Chair Lael Brainard gave a speech in which she basically indicated the Fed is sort of between a rock and a hard place. I think it's actually between Volcker 2.0 and Bernanke 2.0. And so it is kind of a bearish opera. And the conclusion is that the opera ain't over until the Fed lady sings a more optimistic tune. She was very concerned about financial stability. It's really the first time that a Fed official talking about financial stability. And you said on the show that the financial stability is, in fact, one of the mandates. And the question is, how important is it? And I think it's number one.
Okay, it's number one is financial stability. Great. But the fact of the matter is when the facts change, any central bank changes. How close are we to the facts changing where we see it, we observe it in the Fed dialogue?
Well, I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. These are very restrictive monetary developments. And I believe that they're not going to get up to 4.5%, 5% on the Fed funds rate. I think they got one more rate hike coming in early November, and that'll be it because the financial stability issue will pop up as primary concern.
Hold on a second. So, Ed, you think that they're going to raise rates, possibly even by 75 basis points. I'll let you speak for yourself. And then that's it because something breaks. What breaks?
Well, I think it's already breaking. I think what's breaking is the soaring dollar. The soaring dollar has been associated in the past with creating financial crises on a global basis. We have to have a global perspective on all this. And this tight monetary policy here is having a tremendous impact on the rest of the world, especially in the emerging markets where companies do tend to, and governments do tend to borrow in dollars, and a soaring dollar is just killing them.
And Ed, you've been somewhat constructive on the U.S. stock market longer term, more constructive than a lot of people. Correct. And yet Mike Wilson over the weekend said that light at the end of the tunnel that you might see from a Fed that does pause or even pivot is actually a freight train of the oncoming earnings recession that the Fed cannot stop. How do you deal with the earnings recession that will ensue from some of the tightening that would be necessary, a prerequisite for the Fed to maintain that pause?
Well, again, I take a global perspective. From a global perspective, I agree with Mike Wilson that there is a recession out there, but I think it's in Europe, and I think it's in China, and I think it's basically in the rest of the world, and the rest of the world needs a safe haven, and the safe haven is the United States. So the dollar remains strong. Money continues to pour into the U.S. Credit markets, and I think you're also going to see some money coming into the equity markets on a global basis. I see earnings going sideways. I think we're already in a recession. It's just a growth recession. We have had 2 quarters now of no growth. I think third quarter is going to shape up something also similar to that, maybe slightly positive. fourth quarter, a continuation of that growth recession. So I think that's what we experience. I think on balance, we make it through this in much better shape than the rest of the world.
I just want to finish on the bond vigilantes. Your term,
Sure.
you coined it a long time ago.
Yes.
Do you think these central banks will allow the bond vigilantes to wreak havoc through bond markets for longer than a week?
Well, I think what the Bank of England did is an example of what the template for what the others are likely to do. I do think there's similarities between what's going on and sort of moving towards the Japan model of keeping a peg on the long end.
Permanent intervention, possibly, even when they're hiking. Ed, thank you, sir. Longer conversation next time on this. Ed Yardeni of Yardeni Research. I think we can all come up with scenarios, do a various scenario analysis as to how the Federal Reserve pauses, pivots, whatever you want to say.
Exactly.
Is it bullish if they pivot or pause because of financial instability? Is it bullish if they pivot or pause because of a deep, deep recession? Now, the way I phrase this is as follows. If you ask someone if the Fed pauses because they're worried about recession, is that bullish? And someone might say yes. If you phrase it just slightly differently, if the Fed isn't cutting in the next recession, is that bullish? Now, it's basically the same thing, right? Because they could stop hiking. It doesn't mean they're going to start cutting.
Mohamed El-Erian made this point as well, and a number of people have made this point, that be careful what you wish for, because if they actually pause, the circumstances have to be so dire so as to be pretty negative for the rest of the economy. Taking a step back, even if the Fed pauses, if inflation is where it is and it is not rolling over naturally, you have a big problem. It is not just a Fed-engineered downturn. There are some real structural problems in the economy. And that, I think, removes the equation of the Fed even being able to be a put, because it's unclear what will be the savior.
The Fed stepping in, Tom, is still the conversation.
Well, it's still the conversation, and the question is when. And basically there's three scenarios. But what I would focus on, to Yardeni's point, is the Venn diagram using the IMF of the blue book, the green book, the brown book. You've got the economics of it, you've got the fiscal of it, and you've got the financial stability of it. And all of a sudden, like once every 8, once every 10 years, guess what? The green book matters. That's what we're going to see in 2 weeks.
It's dominating.
Dominating. Yardeni's dead on.
Futures positive 0.7% on the S&P. Yield to lower by 13 basis points on a 10-year. Your yield 369.83. Coming up, Jeffrey Sachs, economics professor at Columbia University. Live from New York City for our audience worldwide. Good morning to you on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro with equity futures positive, just about up 0.7% on the S&P 500. Bid into the bond market, yields lower by 12 or 13 basis points, 370 on a 10-year. Euro showing some weakness, euro dollar down 0.4%, 97.66. And just want to get to crude because we haven't talked much about this so far. Up 5%, 83.56, and a conversation now about, Lisa, output cuts at OPEC plus.
1 million barrels potentially, which is the most going back to the heart of the pandemic. Yes, that's a significant amount of barrels cut, not added, right? This is a complete reversal from what we've been seeing. What's the political blowback going to be at a time when you've got OPEC Plus saying they need to support the integrity of pricing that has actually helped the United States and helped many other nations with lower inflation?
Futures up 22 this morning. The heart of Bloomberg surveillance is the quality of our guests, always in every case. And as we spoke to Dr. Yardeni moments ago, we speak now to Jeffrey Sachs to say he's economic professor at Columbia University. Barely describes his contribution. I want to make note that he was 10 years out front on the collapse of American education and the struggle of two Americas. But Jeff, I must digress to your take on the war in Ukraine and on the Russia you knew so well under Yeltsin. You're in the Atlantic this week, and they're equating you with Mearsheimer of Chicago as the realist out there. What should be our response to Mr. Putin with your thoughts on war and aggression after the human atrocities that are reported?
Yeah, I was attacked in the Atlantic for being on the side of peace. And I confess I'm on the side of peace. I am very worried that we are on a path of escalation to nuclear war, nothing less than that. We have essentially a war in which Russia feels that this war is at the core of its security interests. The United States insists that it will do anything to support Ukraine's defeat of Russia. Russia views this as a proxy war with the United States. And whatever one thinks about this, this is a path of extraordinarily dangerous escalation. And I am very fearful.
Right. You lived this with Yeltsin. You were there for Gorbachev and Yeltsin and the rest. I remember when you got off the airplane at JFK, essentially shattered over the collapse of that first experiment. Do you have a feeling that Mr. Putin is alone? Is his military in support of him?
A lot of the world is watching the events in horror, and a lot of the world doesn't like this NATO expansion, which they interpret as at the core of this. They want to see compromise between the U.S. and Russia. In vote after vote in the United Nations, basically it's been the Western countries that have been voting for sanctions and denunciations and other actions, whereas most of the world, certainly most of the world counted by population, is on the sidelines. They just view this as a horrible clash between Russia and the United States. They don't view this as we describe it in the media as an unprovoked attack by Russia on Ukraine. That's, anyone in the United States, they'd say, well, what else is it? But that's because the way that our media have been reporting this. This conflict goes back a long time. It didn't start on February 24th. 2022 in fact, the war itself started in 2014, not in 2022, and even that had antecedents. And so most of the world doesn't see it the way we describe it, but most of the world's just terrified right now, frankly, because it's unbelievable to be hearing on one side, well, we'll use nuclear weapons if we need to, and the other side saying, you can't frighten us.
Well, and Professor Sachs, I share the concern, and I'll be honest, I spent the weekend also reading articles about the U.S. coming up with counterattacks and proposals of what they would do in response to some of these attacks. It's definitely a big concern. It's also an issue as you see this sea change in the economic trajectory in Europe and beyond. And some of this does come from the energy crisis. But suddenly we're talking about inflation that we have not seen since World War II, since potentially another time of incredible distress and military intervention. How close are we to some sort of, I don't want to say hyperinflation, but persistent inflationary impulse well above target in Germany, in the euro area, as they look to these alternative ways to suppress the peripheral region from getting out of control as they raise rates in the front end?
Well, Europe is in a very, very sharp economic downturn. The sharp decline of output and living standards also shows up as a rise of prices. But the main fact is that the European economy is getting hammered by this, by the sudden cutoff of energy. And now, to make it definitive, the destruction of the Nord Stream pipeline, which I would bet was a U.S. action, perhaps U.S. and Poland. This is
Jeff,
speculation.
we got to stop there. That's quite a statement as well. Why do you feel that was a U.S. action? What evidence do you have of that?
Well, first of all, there's direct radar evidence that U.S. helicopters, military helicopters that are normally based in Gdansk, were circling over this area. We also had the threats from the United States earlier in this year that one way or another, we are going to end Nord Stream. We also have a remarkable statement by Secretary Blinken last Friday in a press conference. He says, this is also a tremendous opportunity. It's a strange way to, it's a strange way to talk if you're worried about the piracy on international infrastructure of vital significance. So I know this runs counter to our narrative. You're not allowed to say these things in the West. But the fact of the matter is, all over the world, when I talk to people, they think the U.S. did it. Just to tell you, and by the way, even reporters on our papers that are involved tell me privately, yeah, well, of course, but it doesn't show up in our media.
Professor, I don't want to get into tit for tat about what did or did not happen with Nord Stream, because I don't have the evidence and we don't have a counterbalance to this. There is an issue, though, that's at the heart of what you're saying, which is a lack of trust in the United States, a lack of cohesion in allies in the midst of incredible political as well as economic strife. I mean, do you see the likelihood of working together at a time when there are such disparate interests and feelings of distrust?
The biggest problem is that we have major geopolitical conflict, not only U.S. and Russia, but also U.S. and China. So, and again, with a tremendous amount of provocation coming from the U.S. side as well. So we're breaking any sense of stability right now. For the moment, many in Europe are saying, well, the U.S. is our closest ally. We need to hold on. But watch what's happening politically. There's upheaval in Europe, country after country right now. We're entering a period of enormous instability, and we're unstable in the United States as well. We went through an insurrection. We're still not past that. So we're entering the most unstable geopolitical era in many decades. We're entering the first hyperinflation in more than 40 years, and we're entering the first escalation to the nuclear precipice in 60 years. 60 years exactly this month was the Cuban Missile Crisis, and this is the most dangerous moment since the Cuban Missile Crisis. It's an extraordinary overload, and we see no attempt to tamp this down, to quiet it down. Every day is about escalation. We're going to defeat the other side. We have our rights. We can stand up what we want. We have Speaker Pelosi flying to Taiwan. Right. So many provocations in the midst of huge instability.
Well, Jeffrey, we're going to have to leave it there. Jeff Sachs, thank you so much. Greatly appreciate it. John, we're getting a fiery response from this interview.
Are you surprised?
No, I'm not. And this is what we do with surveillance. There's a different opinion out there. And I would call it small, but there's a considered opinion out there internationally along his line, again, about the expansion of NATO too far, too fast.
I'll be as diplomatic as I can. Can we clarify what we do at surveillance? We speak to experts about things that they are experts about. That's an economist on a rant about international relations.
I will say it was a rant about international relations, but Jeff holds a special spot because he was the lead economic advisor to the failed Yeltsin experience. He has a huge Russian study. Now, after that, you're right. We heard a lot of things there that are controversial.
I heard very little about the actions of Vladimir Putin.
Yes.
I heard very little about the rhetoric coming out of Russian leadership. I heard very little about any of those things. And as for that article in The Atlantic, the journalist of The Atlantic picked a quote from Jeffrey Sachs, and the quote was as follows. Since 1980, the US has been at least 15 overseas wars of choice. Went through several of them, while China has been in none and Russia only in one, Syria, beyond the former Soviet Union. Now, that, of course, excludes Georgia and, of course, excludes what's happened in Ukraine back in 2014 also. And also, in a sense, opens the door to say, well, it wasn't beyond the former Soviet Union, so Georgia and Ukraine is okay.
I think, yeah.
Tom, incredibly complex, some of the accusations that The Economist is making about international relations without any evidence behind it whatsoever. The reason that I'm deeply uncomfortable with someone like that saying those things is because they're presenting no evidence other than saying people don't want to talk about it because it runs counter to the popular narrative in the media.
To the Nord Stream comments, you're right about the evidence was very shaky.
If he turns out to be right, then he turns out to be right. But as a journalist, you don't say those things unless you have evidence to say them.
Yeah, well, he's not a journalist.
And that's why those things are not being said. Yeah. But he's not a foreign policy expert either, and we shouldn't dress him up as one. Coming up at the Open, we'll speak to a bond market expert about bonds, believe it or not. Priya Misra of TD. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's a humiliating reversal for British Prime Minister Liz Truss. She has now dropped a plan to cut taxes for the UK's highest earners just 10 days after it was announced. The move was Truss's attempt to fend off a rebellion in her own Conservative Party. Chancellor of the Exchequer, Kwasi Kwarteng, says the tax cut plan had become a distraction. In a tweet he wrote, "We get it, and we have listened." The European Union is hoping to reach a preliminary deal today on a new sanctions package to punish Russia. Poland's ambassador to the EU said it would likely include the political backing for a price cap on Russian oil. Bloomberg's learned that Hungary has been an obstacle in the talks. The death toll from Hurricane Ian continues to rise. According to the Associated Press, at least 68 people have been confirmed dead. All but 7 of those were in Florida. President Biden will visit the state on Wednesday. Ian was one of the strongest storms to make landfall in the United States. And it's the latest attempt to consolidate the British telecom market. Vodafone says it's in talks with CK Hutchison Holdings about a combination with rival 3UK. Now, the deal would involve a combination of the two companies' UK businesses, with Vodafone holding 51%. Manhattan's EV charging sites now outnumber its gas stations more than 10 to 1. According to data from the U.S. Department of Energy, the borough has about 320 publicly accessible charging locations, compared with the 29 gas stations listed by the New York State Department of Agriculture and Markets. Now, gas pumps still dominate citywide. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
The EU has done a great job of reducing its short-term dependence on Russian gas. And so I think that the added threats will create upward price pressure. It will continue that, but the recessionary fears, the rampant inflation that y'all have been talking about, that creates a downward price pressure that keeps us more in balance.
Virginia Mayer joining us, Global Head of Energy at KPMG, and really definitive out of Rice University, and with her military experience on international economics and politics of hydrocarbons, with futures up 32, Dow futures 281. The VIX comes in finally, some optimism on the VIX 31.45, but I really wouldn't write home on it. Lisa, help me here with the economic data that we see. It's a deluge, I say. And it's ISM numbers. Ferro tells me they're important.
They are important, especially given what we have seen with services slowing down in tandem with goods. We get that later. We also get a bunch of housing data this week. But obviously, the main point of the week is going to be the labor market report. That non-farm payroll is coming out on Friday. How much does that really point to a slowing labor market?
You know, we heard there's some stunning numbers from Bruce Kasman. Thank you for that, the gentleman from J.P. Morgan. Right now in OPEC and OPEC Plus, we go to Will Kennedy, who knows more than me, and it's real simple, Will. It's about Azerbaijan, Bahrain, Brunei, Kazakhstan, Malaysia, Mexico, Oman, South Sudan, and Russia is OPEC Plus. And yet everyone focuses on the path from Moscow to Riyadh. What does the path look like this morning?
Well, as you say, there are 23 countries in this big OPEC Plus group, Tom, but the two that matter have always been Saudi Arabia and Russia. At its heart, it's an alliance between Riyadh and Moscow, to the world's two biggest oil exporters. And I think the fact that they're meeting in person shows that it's very important for the Saudi Arabia to keep this alliance going, to keep the group together, and to really think about what policy is going to be in the year ahead. As we have huge things in the backdrop, the global slowdown, tightening monetary policy, higher dollar, which is putting huge pressure on oil prices, the development of the war in Ukraine. And it's going to be very interesting to see how radical a policy response we're going to see at this meeting, the first face-to-face meeting since the pandemic on Wednesday.
Well, how much political pushback is there going to be if OPEC Plus does go through with a 1 million barrel production cut, not hike, which is what we were talking about just months ago, in the face of still inflation concerns worldwide?
Well, prices have come up a lot since the summer, and I think that's a concern clearly to OPEC producers. And there is some worry that the world may be a little bit oversupplied, but it's a little hard to see that when you look at the numbers. Demand is still fairly robust, but clearly OPEC feel a need to get ahead of things. So it will be interesting to see how Washington reacts. 1 million barrels a day, I think it's worth pointing out, is almost 10 times the hike that came out of that meeting between Biden and Mohammed bin Salman earlier in the year.
How much is Russia going to be a part of this particular OPEC Plus meeting? Will the Russian energy minister be in person with them for this meeting?
We don't know yet. That's not clear. We're still trying to get a final list of those people that will participate in person and those people who will participate virtually. He has been sanctioned by the US, but it's important to note he is not under sanction in the EU, so it's fairly possible that he will be able to attend if he wants to.
Will, we are ever so fortunate to have you here with your team's work in Denmark and around the North Sea and over to the Baltic as well on Nord Stream and all of the upset of the rupture. I don't know if you're aware, Will, we just spoke to Jeffrey Sachs in a hugely controversial interview where he basically implied the innuendo that the U.S. and Poland were involved in some form of rupture or damage to the pipeline, and it's created a firestorm for surveillance out on social. What is Bloomberg's reporting on the damage of Nord Stream 2?
Well, the reporting is that the damage is severe, that it will be very hard to ever repair these pipelines, although the Russians have said recently that it would be reparable. We do not know for certain who did this. That's the important thing to say. But we do know it is sabotage, that it was done deliberately. And it is hard to understand why those countries would want to do that. Beyond that, I don't think we know. I think we need to wait for people to investigate. And it's interesting that I think Sweden and other nearby countries are putting assets in play that may actually be able to look at the pipeline and determine exactly what happened, because beyond the fact that this was done deliberately, we do not know how it was done. Until we know how it was done, we cannot say definitively who did it.
And I've seen the reports of Sweden with, I'm going to call it undersea robots and even divers going down to look. Am I somewhat close?
Yeah, that's right. And it is possible that there's a depth where we can send people down there, probes down there. And, you know, if as that happens, we will quickly be able to probably build a picture of how this was done. And as I say, once we know how it was done, we may get closer to knowing for sure who did it. Although lots of people have their views, and many people in Europe, including the Poles, have pointed towards Moscow.
Will Kennedy, thank you so much for your reporting and to all of your team following this hugely controversial story. What a firestorm, Lisa, off of the conversation with a gentleman who was with Yeltsin years ago but has changed over the years.
Well, it becomes very difficult. First of all, it's really important not to make any allegations without tangible proof. And if we do not have tangible proof, which we do not, then we should not be making allegations. And I think that that's full stop. And I think whoever we have on, it applies to them as well. There is an issue at this moment as you try to figure out who did it and what is behind it, is the potential for escalation and that kind of concern, whether with respect particularly to Moscow, right? I mean, especially with fingers pointing there, of what kind of response this is, and the fact that we've got energy ministers in the European Union speaking in Luxembourg and talking about how do we deal with a very difficult winter and the idea that we cannot rely on Russia anymore at all for our energy needs.
And I think you've brought that up really well, that the calendar matters. And it is the first business day of October, and all of a sudden, winter is upon us. I've seen different reports, and they're as good as the weather in New York City. I'm really not sure, other than frankly, as Professor Sachs mentioned, it's a sobering time. We can all agree on that.
It's a sobering time. And I think that, his remit, at least in terms of what he's a professor in, of economics, it's a very interesting time in there as well, and a revolutionary time if you take a look at inflation rates unseen since what we have seen since the World War II, at least in Europe. How do you grapple with that after becoming accustomed to Federal Reserve intervention, ECB intervention on the other side, on lowering rates further? And that has always been the playbook, and this is a totally new world.
Our playbook is the data as we go to the jobs report on Friday, and what we can say is sterling with a bid continuing here through the morning. We had a 111, Lisa, now 112.25, stronger sterling off the news flow there, and even yen is stronger as well against a pretty much flat dollar this morning.
So here's one big debate. How much will Japanese officials be willing to come in and keep supporting the yen? Is it at 1.45, or is this just a controlled weakening in order to wait, to buy time for the dollar to depreciate.
We got to go. We'll talk about it tomorrow. But one calculation is the wealth of Japan is so great. They've got many tranches of intervention they could do if they choose to do it. The eventful news flow continues on radio, on television on this Monday to Jobs Day on Friday. Stay with us. This is Bloomberg.